Okay. Okay. Good morning, everyone. Um Welcome to this session on financial reporting for CA Final. This is a new topic that has been introduced in the the examination for May 2022 attempt onwards. Okay, that is the conceptual framework for financial reporting under the Indian accounting standards. So it is a very important topic in the sense that it is new. Okay, and as we all know that new topics are the favorite for examiners. But if it is a new topic, does it mean it is difficult? No, it is definitely not difficult. Okay, it is an understanding of things which you are already aware of, particularly those who had attended the previous sessions on Ind AS for the November 21 May 22 batch. You would already be familiar with what Ind AS require. Okay, you are already familiar with the various criteria, the various reporting principles that are laid down in the Ind AS, the various Ind AS which you have studied. This chapter, the conceptual framework, is just a prequel to what you have studied. Okay, you know what is a sequel, you know what is a prequel. Prequel means this precedes my Ind AS. Okay, this is the foundation on which your Ind AS is firmly set. Sir, this conceptual framework came in 2018 by the IASB, and we have drawn it recently. That is, the ICAI has taken it from the IASB's conceptual framework for financial reporting under IFRS. In fact, if you see the bare framework, it is exactly the same. What has happened was there was a framework for financial reporting under Ind AS earlier. Earlier means what? It was present in 2010. 2010 May we had the conceptual framework. After the conceptual framework, IFRSs were introduced. Then there were found to be certain inconsistencies. And to mitigate those inconsistencies, the new conceptual framework was released in the year 2018 by the IASB, International Accounting Standards Board. The institute adopted this conceptual framework for standard setting with effect from the year 1st April 2020. And for the preparers of financial statements, that is the persons who are reporting under Ind AS, this conceptual framework is applicable to them for the reporting periods on and from 1st April 2021. So what does it mean? For the standard setters, in India, this is applicable from 1/4/2020 for the standard setting activity. Which activity? Standard setting activity. That means already this is in force for the institute which sets the standards. And then you are having the preparers of financial statements. For them, this is applicable from 1st April 2021. What do preparers of financial statements do? Preparation of financial statements. So for the year ending 31st March 2022, this will be the first year when the conceptual framework will be in force. And that is why when you are going to pass from the May 22 attempt, you will be the first batch who will come under the revised conceptual framework. Okay, so now with this background, let us discuss what are the topics which are going to be covered today. It's a theoretical chapter. There is not much practical problems that you get to see in this, but in spite of it being a theoretical chapter, there are a lot of practical applications to this. Okay, so what are those applications? How do we see it in Ind AS? How is it in synchronization with my Ind AS? We will now discuss. I'll share a presentation towards the end of today or tomorrow. Okay, so please do download that. It's largely based on my study module. So today's study will go through the study module, and then you can refer the presentation for ease of presentation, those kind of things. Okay, so what are we going to discuss in your conceptual framework? What is the meaning of general purpose financial reporting? What are its objectives? What is the usefulness? What are the limitations? And what is the information provided by general purpose financial reports? Once that is done, we move on to the qualitative characteristics of useful financial information, which could be qualitative, which could be the cost constraint on useful financial information, as well as certain enhancing characteristics. I have basic characteristics and I have enhancing characteristics. We shall look at them in detail. Then you have financial statements and the reporting entity. When I talk about financial statements, what do I mean by financial statements, and who has to prepare those financial statements? So these two things we will be looking into. Then we have the elements of financial statements. Elements means what? Elements means your assets, liabilities, income, expenses, equity. So what are my elements of financial statements? The link between the information. What is the link between the elements and the definitions of your asset, liability, equity, income, and expenses? Recognition and derecognition. How do I recognize my elements? And if they fail to recognize, if they fail to meet the criteria for elements, when do I derecognize them from my financial statements? So this is what we will be discussing in the recognition and derecognition. Then you have measurement. What do you mean by measurement basis? Many of you are aware, and you must have more commonly heard, that Ind AS is a fair value reporting concept. Okay, you must have studied IFRS means a fair value model. Ind AS is adopted from IFRS. So Ind AS also is a fair reporting framework, but this framework helps to clear the concept of what are the measurement bases which are allowed. You could be having historical cost as a measurement base. You could be having fair value as a measurement base, value in use as a measurement base, current cost as a measurement base. So these are all the measurement bases. And then once we close this chapter, you will understand that what we follow is not a fair value reporting framework, but rather we follow something known as a mixed reporting framework, where some items are under the cost model, some items are under the fair valuation model. Okay, then what do you mean by presentation and disclosure, and certain small concepts of capital and capital maintenance? Okay, so these are going to be the topics which we will be covering. Okay, so with this, let us start our discussion on Ind AS. What is the purpose of the conceptual framework? Framework kya karta hai? What does it do? Well, it assists ICAI in formulation of Ind AS. So the first thing is standard setting activity. This is my standard setting activity, and the formulation to be based on consistent concepts. Okay, we will see in the future how my Ind ASs have consistently adhered to the framework. In some cases, you may note that there could be an inconsistency. What do we do in the case of inconsistency? That also we will look at. Okay. The next thing is it will assist the preparers to develop consistent accounting policies when no Ind AS applies to a particular transaction or event. Okay. So best example, when no Ind AS applies to a particular transaction or event, is purchasing cryptocurrencies. Okay, purchasing cryptocurrencies. This is the buzzword of today. Blockchain technology, cryptocurrencies. Yes. Now, what exactly are cryptocurrencies? Do they meet the definition of cash and cash equivalents, or do they not meet cash and cash equivalent definition? If not, then what are they? We do not have a specific standard that covers discussions on cryptocurrencies. So therefore, there is no guidance in the Ind AS framework. So that point of time, what is going to help us? It is the conceptual framework that will help us in deciding how my cryptocurrencies should be reported in the financial statements. Okay, that is the first thing. Second thing is, when an Ind AS allows a choice of accounting policy. What do you mean by choice of accounting policy? In the standard Ind AS 16, that is property, plant and equipment, you are having the option to follow the cost model, the option to follow the revaluation model. Consistently, you will have to follow a particular model. That guidance is given by your conceptual framework. And finally, it is going to assist all the parties to understand Ind AS as well as to interpret your Ind AS. So this is what goes under the conceptual framework. The most important part is nothing in the conceptual framework overrides any Ind AS or any requirement in an Ind AS. Okay. So now this is important. My conceptual framework is a base. It is a foundation. But with the fast evolving trends, the fast changing business world, you have instruments, you have assets, you have liabilities, which have to be accounted for in some manner that gives a better picture of financial information. So what does it mean when we come to the qualitative characteristics? You can understand relevance and faithful representation. I may have to depart from the requirements of the framework to ensure I give a more relevant and faithful representation of my information. And that departure is enshrined in a particular Ind AS. Now, if that is the case, there will be a conflict. On one side, you have the framework telling something. On the other side, you have the Ind AS telling something. So who will override whom? And obviously, it is the Ind AS that overrides the conceptual framework. It is the Ind AS that overrides the conceptual framework. This is applicable for standard setting activity, as I have told you, with effect from 1st April 2020. And for the preparers, it is applicable from 1st April 2021. It's already notified. Okay, so that is why you are having it in your syllabus. Okay, so now, good morning, Namita, Suraya, good to see you. Yes, all right. So now let us come to our proper, what you can say, the chapter. We have in all 9 units. Many of the things you already know. I repeat, many of the things you already know. So I will not be spending much time reading each and every line of this chapter. That is not what I'm here for. Okay. I will explain the definitions, explain the concepts, and where the concepts are complex or difficult to understand, or if I may put it, where the concepts are verbose, hum pad nahi sakte because there are a lot of words, that I will explain in simple language. But many things you are already aware of. So we will now proceed to that. What do you mean by general purpose financial reporting? And what are the objectives and usefulness of general purpose financial reporting? So basically, general purpose financial reporting, you and I already know. Okay, your balance sheet, P&L, cash flow, notes, statement of changes in equity, all these form a part of your general purpose financial reporting. It is a general report. It does not cater to any particular class of readers of financial statements. Sir, do we have specific purpose financial reports? Definitely we have. Definitely we have. One is your general purpose financial reporting, which caters to large number of users. Okay. This large number of users moves from investors, analysts, government authorities, all these people it caters to, regulatory authorities, etc. But you have specific purpose financial reporting. Sir, example of specific purpose? Well, let us take a due diligence report. A due diligence report. Okay. What you can say, Tata acquired Air India. Tata acquired Air India. If you have seen the news, practically the last couple of months prior to making the bid, there were consultants on behalf of Tata sitting in the Air India office. What were they going to do? They were going to review all the financial information of Air India for the purpose of enabling Tata to make a competitive bid. Now, this becomes a due diligence report, a specific report for investing in Air India and getting control over Air India. This becomes a specific purpose financial report. You give this due diligence report to a regulatory authority, wo bolega, what am I going to do with this? This is an analysis of claims, contingent liabilities, assets, policies, all these things you are going to analyze, not necessarily what has happened, but what may come in the future. So this is a due diligence report, a specific purpose financial report, which is not covered under the conceptual framework. We are focusing on general purpose financial reports. Okay. So the objective is to provide information that is useful to which class of individuals or users? Useful to existing and potential investors, lenders and other creditors in making the decisions regarding providing resources to the entity. Investors invest in equity, so they give resources to the entity. Lenders give loans or borrowings, so they also give resources. Creditors are also going to give their resources in the sense they give credit. So they give raw material with payment cycles varying differently. So they are giving their resources. So basis to ensure that these people are comfortable with giving those resources, you have the requirement of giving the general purpose financial reports. So these decisions involve about buying, selling or holding equity and debt instruments, providing or settling loans, exercising rights to vote on. So this is what is your objective and usefulness of general purpose financial reporting. But any limitations? Yes. They cannot provide all the information that existing and potential information and lenders need. Okay. In a general purpose financial report, you will never look at information such as what you can say, what are the plans of the entity in the future? That you will never find in a general purpose financial report. What are the investments you are considering? You will never find that in a general purpose financial report. You may find it in management discussion and analysis, but you will not find it in your balance sheet and P&L. By large, my general purpose financial report, GPFRs, focus on what has already happened, presenting it before the users. We generally do not prepare forward-looking financial statements. So they cannot provide all the information to existing and potential investors, lenders, and other creditors. You will have to look at the industry information. For example, Tata acquired Air India. So the potential investors in Tata will probably have to look at what is the airline industry scenario in the future, and basis that they can make a decision. Okay. Tata in the balance sheet P&L notes will never tell you about the detailed due diligence that has undergone in making investment in Air India. So that information won't be available to you. Okay. They are not designed to show the value of a reporting entity. What do you mean by the term? As a value to dikhata hai na. When you say value, it means assets minus liabilities. That means your net worth, or what we call as equity and shareholders funds. Sir, value to dikhata hai. Does it truly represent the value? It doesn't. Value, when I talk about, is a strategic financial management concept. Okay, when you perform valuation of equity, when you perform valuation of securities, your financial statements, they do not show the value of the reporting entity. You cannot say that looking at the balance sheet, my shares should trade at such and such value. Can you tell that? You cannot, because this is an accounting concept. This is a reporting concept. This is not a valuation concept. You don't have valuation principles enshrined here. But yes, they do provide information to help existing and potential investors, lenders, creditors to estimate the value of the reporting entity. Can I estimate the value? Yes. You look at the comparative figures, look at the past trends. You can analyze the revenue in the future. You can analyze the costs, the expenses in the future. Basis that you can determine the cash flows. And once you determine the cash flows, you can extrapolate it to arrive at a terminal value. And with the cash flows and the terminal value, you can discount it to present value to arrive at your valuation. That is a specific valuation, but iska base, the information for this valuation came from where? It came from my general purpose financial reports. And finally, these are not primarily directed to other parties. I gave you the example of due diligence reports. I gave you the example of due diligence. It's not for your creditor. Creditor kya karega? He is giving raw material. Creditor will never invest in an entity in which the entity is considering to invest, and therefore it's not directed. So therefore, this is a very, very general reporting that is given. So what is reported in my financial information? Well, you have the financial position, that is the assets and liabilities. You have effects of transactions and other events that change the entity's resources and claims. That means financial performance, that is your comprehensive income, which we call it as statement of P&L and other comprehensive income. Okay, so this is your comprehensive income. Cash flows and changes not resulting from financial performance. This is nothing but my statement of changes in equity. You may have made a fresh issue. I mean, you may have made a issue of equity shares. Now, issue of equity shares is increase in the resources, but has this increase happened because of financial performance? No, it hasn't. And therefore, your assets increase on one side, equity increases on the other side, but इसका आपके ऑपरेशन के साथ कोई संबंध नहीं है. This is not related to your operations. This is related to a fresh issue. अच्छा, even dividends that you declare, dividends that you distribute, your cash goes down, asset position goes down, but can I say dividend is an expense? Answer is no, it isn't. It is not a measure of financial performance. It is a distribution of the earnings with your owners. And therefore, it brings down the value of my assets. It brings down my cash bank balances. So therefore, that will also be reported. So normally, if I talk about my financial information, it will cover assets, liabilities, comprehensive income, cash flows, and statement of changes in equity. Is it okay? Yes. So when you talk about economic resources and claims, that is assets and liabilities, why do I need to report that? Well, that is to identify the reporting entity's financial strengths and weaknesses. This can help the reporting entity, the users, to assess. Users will assess the entity's liquidity and solvency. Okay. Pick up the balance sheet of any airline company. Pick up the balance sheet of any airline company other than Indigo. Okay. The airlines which are bleeding cash. For example, SpiceJet. For example, your, what you can say, Go Air, for example, or Go First as it is now called. Pick up any airline company's balance sheet. They are bleeding cash. Their bleeding cash means what? The net worth has gone negative. So now you can interpret that the net worth is negative. That means the going concern concept probably is not going to last for a very long period of time. Okay. So that becomes an important assumption or presumption or information that we can derive from the particular economic resources and claims information. The needs for additional financing. You can also derive your information from the general purpose financial reports and how successful it is likely to be able to obtain the financing. Today's date, if any airline company comes out with a public offer, what will be the chances of its success? Probably very less because the industry is yet to stabilize due to the COVID pandemic, right? But as of now, it's not going to be a very successful public offer. And therefore, this assessment is what will, this information is what is going to aid the users in assessing the entity's needs for solvency, financing, and success in getting the financing. Second is assessing the management stewardship of the entity's economic resources. Have you heard the word stewardship? What do you understand by the term stewardship? Can somebody just type in the chat box? Don't Google search, okay? Don't do a Google search. अब सब तेज लोग हो, okay? So don't do a Google search, but just tell me, what do you mean by management stewardship? What do you mean by stewardship? Any answers? You must have heard of this term as far as I know. Yes, any answers, anyone? Stewardship? No idea. Okay. See, what happens is in a company, okay, in a company, you have investors. For example, you guys have invested in a company like say Reliance Industries. Okay. आपने अपना पैसा डाल दिया Reliance में. Okay. You put your money in Reliance Industries. Technically, as per the Companies Act, you become owner in proportion to how much you have invested, how many shares are you owning. Okay. So therefore, you become the owner of the company, technically speaking. Sir, if you are the owner, are you running the company? No, sir. I do not know how to run a telecom company. I do not know how to run an oil and chemicals business. मेरे को कुछ नहीं पता. I do not know. I just know that if I put money in Reliance, the company is doing well, my wealth will increase. So what do you do as an investor? Sir, you appoint management. You appoint management. Management का मतलब क्या? The board of directors. Okay. You appoint the directors. Now these directors will run the company. They will run the company. Okay. They will take decisions about operations. They will take decisions about what you can say, making new investments, about disposing of certain investments, right? So there is a separation. There is a separation between ownership and management. You are the owner, but you are not managing the affairs of the company. Whereas the directors may or may not hold. Okay, may or may not hold. Okay, so I'm not concerned with that. The most important thing is the owners are not running the business. So therefore, risk, who is the one who is risking? Sir, it is my investors who are bearing the risk. They gave their money in the hands of the management, some third person who is running the company, and they trust him with it. Now, this trusting means that the management has a responsibility. There is a fiduciary relationship. Fiduciary relationship means what? The directors are keepers of the trust of the investors. They have to protect the trust that the investors have in them. And therefore, they are managing the resources of the company. They are managing the resources, means assets of the company, in a manner such that the investor's wealth is not compromised. The investor's wealth is rather maximized. This activity of managing the entity's resources on behalf of investors is what is known as stewardship. You are managing somebody else's wealth, somebody else's resources, for maximizing the return to them, for maximizing their wealth. So this is known as your stewardship. This is known as your stewardship. You are stewarding the resources, the trust that the investors have given in you. And therefore, this is to assess the management stewardship of the entity's resources. You made a profit. That means the management has worked hard to ensure that the company is a profit-making company. But you made a profit by selling pristine assets. That means the management is not good in managing your resources because it has to sell assets to clear its liabilities. So you are now going to get an idea with the help of general purpose financial reports about what is the management stewardship of the entity's economic resources. And finally, you can predict how future cash flows will be distributed among those with a claim against the reporting entity. So in your balance sheet, you are having liabilities, you are having provisions. So when you look at the balance sheet assets and when you look at the liabilities, you know, acha, these are my assets, this is my cash. Immediately the cash will be used to pay such and such liability. Further, the liabilities are classified into current, non-current. So you are able to now ascertain how much of these resources will probably be utilized to repay the liabilities within 1 year, how much of it will go beyond 1 year. So therefore, you can predict the future cash flows. So when you analyze your financial statements for the purpose of determining the value of the company, you know for certain when you're calculating the cash flows, you know how much of that cash is going to meet my liabilities. And therefore, you are predicting how the future cash flows will be distributed. Okay. So this is what is your information about economic resources and claims and how it is going to help the users to assess the information. So when we take LIC policy for earning purposes, is it stewardship? You taking LIC policy is not stewardship, but LIC taking your money as a policy holder and investing on your behalf, that is stewardship. That becomes stewardship. Okay. And that is why today when LIC is coming out with an IPO, there is a special quota that is reserved for the policy holders, because policy holders are indirectly investors in the LIC. They are indirectly investors in the LIC, and therefore it is exclusively for your benefit. You are going to get the benefit, but you are trusting your investment, right? You are investing for 20 years, 30 years, 40 years. And therefore, LIC has a fiduciary duty to its policyholders. Fiduciary, as Srinidhi has rightly said, it is a relationship of trust. You are trusting LIC to come to your help when you need financial resources in the course of an untoward incident. Therefore, there is a fiduciary relationship. And that means LIC's management exercises a stewardship role towards its investors, policy holders, equity holders, lenders, etc., etc. Okay. So is it clear, everyone? So far, is it clear? Yes. Any doubt so far? Anybody? Yes. Anybody has any doubt so far? Anybody has any doubts, any questions, or can I proceed further? Okay. So whatever I have discussed, explained, is all there in these pages. Okay. So there is nothing new in this. I'm proceeding further. Okay. No doubts. So then I shall proceed further. Okay. All right. Now let us move on to the next one. Qualitative characteristics of useful financial information. हम quantitative तो सब जानते हैं. We are very good with numbers. But when I talk about qualitative characteristics, what are they? So my framework has prescribed two characteristics. The first one is essential characteristics. Essentially kya hona hai? What should be there? And the second is enhancing characteristics. Enhancing characteristics. That means what? This is mandatory to fulfill. You have to ensure that your financial statements are prepared to give out these two characteristics. Enhancing is encouraging. They are a support to your essential characteristics. They are a support to your essential characteristics, but they are not so important as essential. So एक तरह का moral support है. So what are these characteristics? The first one is relevance. The first one is relevance, and the second one is faithful representation. The first is relevance, the second is faithful representation. What do you mean by relevant financial information? Financial information with a predictive or a confirmatory value or both makes it capable of making a difference in the decisions made by users, makes it relevant financial information. Sir, you have only read what is there. Okay, aapne bataya nahi. So what is there? So what is there? Now, predictive value. Acha. Now, you have the balance sheet and P&L of, let us say, SpiceJet Limited, okay, which is a company operating in the airline industry. These are available to you. So therefore, you have the balance sheets of the year 2018, 19, 20, 21, 22. Aega abhi. Okay, so this is the future. Now, based on the past revenue trends, as an analyst, do you think you will be able to analyze how much revenue targets would be met by 2022? Yes, you will be able to do that because you see a pattern. You look at the notes to accounts. In the notes, they will give detailed information. Okay. Like, for example, the impact of the pandemic on the operations is a very significant matter. It will be given in the notes to accounts. So the information of the revenue appearing in the P&L along with the pattern that you have observed, and you suddenly got hit by the pandemic, and what is the dent, what is the what you can say the reduction in revenue will also be given, and how do you expect it will flow in the future, that is also given. So based on 2020 year ending was normal, 2021 was a very abnormal year because almost 3 to 4 months you did not have air traffic at all, and when it resumed, it started off in a very, very slow pace. It picked up somewhere in the month of Jan, but again you had the second Delta wave that came in the month of, I don't remember, March, April probably. Then again it went into a, what you can say, a dull mode, and then it picked up. Then Omicron has come, and then it again went down. So you are having a wave-like pattern. Are you able to predict this? To some extent, yes. So could you possibly predict? Yes, 2022. Let us come back in time when pandemic was not there. You are supposed in the year 2019. Abhi tak balance sheet bana nahi hai. It's not yet done. You are now going to assess. So 2018, 17, 16, 15, all these data is there. So basis that 2018 tak ke financials, can you predict the revenue targets for 2019? Yes, I can. And once 2019 year is done and the balance sheet is prepared, the P&L is prepared, and the reports come to you, you can test your prediction to get confirmation of the same. So any information that gives a predictive value. Sir, I can predict what happens in the near future. 10-20 saal baad I cannot predict. I am not so talented. I do not have that data. Nobody can. But within the next 1 year, what will happen? Within the next 2 years, what will happen? We can definitely make an assessment. And therefore, when I can make an assessment, I know how much am I going to, how much revenue is going to come. So this is a predictive value. Once the year is done, you get the actual figures. What you had predicted, did it actually materialize? So that becomes a confirmatory value. So now coming back to my relevant financial information, it is any financial information with a predictive value or a confirmatory value or both. And when I'm only looking forward, abhi tak the period has not come, it will be a predictive value. Once that period has come, predictive becomes a confirmatory value or both. Okay, so it makes it capable of making a difference in decisions made by the users. So now basis that, you will then decide, do I have to invest in SpiceJet or not? It is a company that is recently turned profit for the first time after the pandemic, but it was a company that was a loss-making company earlier. So would you invest in SpiceJet? Probably no, I wouldn't. And therefore, these information becomes relevant in helping you to decide not to invest in SpiceJet. And therefore, this information becomes a relevant information. This becomes a relevant information. It has a predictive value if the information can be used as an input to processes employed by users to predict future outcomes. Who are the users? They could be investors, they could be analysts, etc. Okay, so financial information is a base. Yaad rakho, company is not predicting, but users are predicting based on the past information. Okay, it is employed by the users in making their own predictions. Unke khud ke predictions hote hain. When analysts tell that a particular value of a share should be X rupees, they have to justify that value. So they make predictions. How they make predictions? Based on useful financial information, and then they will confirm it. So financial information has confirmatory value if it provides feedback about the previous evaluations. So these are interrelated. Okay, these are interrelated. Okay. And finally, relevance will also include the concept of materiality. Yes, so materiality now is something which is related to each organization. Okay, this is materiality from the perspective of reporting, not from the perspective of auditing. Okay, so therefore the institute cannot specify a uniform quantitative threshold for materiality or predetermine what could be material in a particular situation. For me, 1 crore is a very material amount, but Reliance ke liye 1 crore is like pocket change. So 1 crore ka rounding of error in Reliance Industries financial statements is acceptable. I repeat, it is acceptable because that is a rounding of error. But in my case, a 1 crore rounding of error could probably mean that it can either make my fortune or destroy me completely, right? So therefore, materiality depends on entity to entity, right? It's not restricted to a particular, you cannot give a benchmark, and therefore in the conceptual framework, materiality ka benchmark nahi hota hai. It is just saying that relevant financial information means you must factor in the materiality concept also. What is material will be decided by the users and the preparers of financial statements. Okay, so ICAI cannot specify, it has not specified the quantitative threshold. Okay. Next, the next thing is faithful representation. Faithful representation simply means always report on substance over form. Always report on substance over form. What do you mean by substance over form? Legal form may be something, but the actual transactions may be something else. Classic example is a lease. Okay. Classic example is a lease transaction. Okay. A lease transaction appears to be that of a rental transaction. But if you look at the lease terms, when you are leasing the asset for a substantial period of time, or when you are giving the option to repurchase the asset and it is likely that the asset will be purchased by the person who is going to pay the lease rents, then all these things are going to give you the information that कहने के लिए this is a rental transaction, but in reality this is actually a sale of an asset over a deferred period. So therefore the concept of financial lease arises, and you have the concept of ROU asset that is there today. Confirmatory. One second, Namita. Confirmatory. Line was not clear. Okay. Financial information has confirmatory value if it provides feedback about previous evaluations. So now let me just explain with an example. 2018, you have revenue figures, you have expense figures, and then you have cash flows. I'm taking a very simple prediction. Okay. 2019, you are going to predict. So you will predict certain revenues, you will predict certain expenses, you will predict certain cash flows. Now you predict, and basis that you decide what will be my cash flows in 19, 20, 21, 22. You go on predicting, and therefore you arrive at the value of the share. Okay. Value could be by using Gordon's formula or that dividend discount model jo padha hai aapne, or by using any of the various methods that you have for determining the value of equity. Now, you have predicted this. When did you predict? Somewhere in 2018-19. Now, 2018-19 में आपने predict किया. You determined the value of the share कि by the end of March, this should be the value. So you please invest. This is based on your prediction as an analyst. Now the question that arises is 2019 khatam ho gaya. So now you have your predictive values. You have your predictive values of revenue, cost, and cash flows. Right? And you now have actuals. So these actual figures are giving a confirmatory value to your predictions. And that is what makes revenue disclosures, expense disclosures relevant, because they are giving you a confirmatory value to what you had predicted in the year 2018-19. Kitna hoga, you will come to know only after the year is complete. But when I predict, will my predictions match the reality? Yes or no, that depends on when the year gets over. And that information gives a confirmation of the predictions that you had made in the year 2018-19 about the revenue, expense, cash flows for the year 2018-19. So your financial information is relevant if it provides what you can say predictive value as well as confirmatory value, or confirmatory value, or both. And normally what gives a predictive value in the future will give a confirmatory value. You are estimating revenue based on your predictions. Sir, next year may revenue ke figures aa jayenge na, so that confirms. So it was a predictive value earlier, later on after the actuals came, it is going to get a confirmatory value. Okay, so Namita, I hope that it is clear with you. Yes. So now coming back to my discussion on faithful representation, you will have to ensure that you follow the substance over form concept. You follow the substance over form. In many circumstances, the substance of an economic phenomenon and its legal form are the same. Many cases they are the same. Okay, and when they are the same, to chalo theek hai, you can proceed with reporting as it is. But if they are not same, then you have to ignore the legal form and you have to represent the true form. You have to represent the substance of the transaction. Another classic example is what we have discussed, reverse acquisition, which is given in Ind AS 103. Legally, it appears that A Limited is acquiring B Limited. This is my legal picture. But when I look at the substance, it is B Limited acquiring A Limited. And therefore, when you prepare the consolidated financial statements, it will be prepared showing this substance. It will be prepared showing this substance of B Limited acquiring A Limited, and not the legal substance and not the legal form. Okay. So you will go for a substance over form presentation. Sir, advice given by news for investing. Will experts use these predictions only? Unke paas what else they have? What is there with them is there with you also. It is just that they have procedures and they are very strong in their activity. They are very strong in their, what you can say, tools, that they have charts, models, etc. that can probably extend to 20, 30 years down the line, how it will pan out. Because they have those resources, they have those people who are strategized in these kind of predictions. So it is all a predictive value, Namita. So news mein aap jo kuch bhi dekhte ho, it is based on these kind of predictions. They make a prediction of the cash flows that you are going to achieve. We all know that value of an asset is nothing but the present value of the future cash flows, which is going to come out of that particular asset. So equity hai. So what are the future cash flows that will come? So you are going to predict those cash flows. How are you predicting? Based on whatever past is there with you. And this past becomes reportable when the future has already been, what you can say, the time has already passed in the future. So it will give a confirmatory value. Wo confirmatory value say they will revise the subsequent predictions. Then again confirmatory value. So it goes back and forth. It goes back and forth. Okay. Now, coming to faithful representation. To be a perfectly faithful representation, 3 characteristics you have to fulfill. It should be complete, it should be neutral, and it should be free from error. So what are the 3 things? Complete. Complete means make all disclosures, information, give everything for a user to understand the phenomenon being depicted. Okay, give complete. So if you remember, whenever I present borrowings in my financial statements, along with the borrowings, I write down it is secured against hypothecation of so and so movable asset, or I will say secured against mortgage of so and so property and the personal guarantee of so and so directors. All this information completely gives you the understanding that against this liability, the first claim on so and so asset is against this liability. So tomorrow, suppose this company goes into liquidation, this asset is not going to come to me, the equity holder, immediately. First, it will be used to meet the liability. So this is going to mean complete information. This is going to mean complete information. The next one is neutral. Neutral means what? Don't have bias in presentation. Don't have bias. जो है उसे present कीजिए. Be neutral. This is difficult. This is difficult. Okay. If I have to give examples of neutrality, right? In Ind AS 19, employee benefits. If you remember, there was something known as short-term compensated absences. Short-term compensated absences, where you had vesting and non-vesting. Vesting and non-vesting. Against leave that you take, you get cash. Against leave that you take, you get further leaves. That means you are going to accumulate those leaves. So therefore, when leaves are getting accumulated in the future, what does it mean? You have to recognize, or what I can say, estimate the leaves that will be availed in the future. We have done this question. So when you estimate the leaves that will be availed in the future, basis that you determine the employee benefit cost today. But this is, my friends, an estimate. Estimate has a human element in that, and therefore there is a chance of bias. There is a chance of bias, and you should ensure that your financial statements are free from bias. Okay. Determining useful life of property, plant and equipment. This useful life is again going to be an estimate. So you should ensure that you remain neutral. You remain neutral. Prudence, you have to exercise prudence. Prudence means what? Do not understate or overstate your assets, liabilities, incomes and expenses. What is the information? Please present that and be done with it. Okay. And finally, we have the last criteria, that is free from error. Error does not mean perfection. मेरे को perfection नहीं चाहिए. What I want is a complete neutral picture with a fair idea of my figures. मेरे को 100% accurate नहीं चाहिए. I don't want 100% accurate figures in my financial statements where estimates play an important role. You estimate that your property, plant, equipment has a life of 15 years. Instead of 15 years, in the future, it got used for 16 years. You cannot penalize the preparer of financial statements saying that how did you estimate 15? Asset to abhi bhi chal raha hai. Arey bhai, it is an estimate. You cannot hold him to ransom and say that how did you estimate? He made an estimate of 15. Asset ran for 16 years. So theek hai, it is fine. Nothing wrong in that. 15 years estimate kiya. It got used up completely. You purchase a laptop. You think the useful life is 3 years. But within 1 year, it became obsolete. Arey, so why are you blaming the company for that? It is his estimate. Basis that estimate, he calculated the depreciation, he calculated the expense, and now there is a change in estimate. So you do not talk about error being perfection. I don't want perfection. What I want is a faithful and relevant presentation. That's it. That is what is crucial to my financial statements. That is what is crucial to my financial statements. Okay. So there are various estimates. Net realizable value, fair value of investment of an unlisted entity, provision for doubtful debts, useful life. All these are estimates. These estimates are essential for preparing my financial statements. You are preparer of financial statements. Aap Bhagwan nahi ho. You are not God to decide what will be the useful life exactly, and it will not pan out like that. Okay. So therefore, make a reasonable estimate and present, and you are on the right financial reporting path. Okay. All right. So this is my essential essential qualitative characteristics, which are essential characteristics are somewhere I had written mandatory. So this is relevance and this is faithful representation. Your financial statements must and should meet my essential characteristics. Then you move on to enhancing. Enhancing means these are those features which increase the relevance or better present your financial information. So they are enhancing in that sense. So when I talk about enhancing, it means comparability, verifiability, timeliness, and understandability. These are the 4 things that you are having as enhancing qualitative characteristics. Let us discuss each one of them with an example. Comparability. Comparability की हम अगर बात करें, when I talk about comparability, you remember change in accounting policy. As per the relevant Ind AS, I think it is Ind AS 8. Yes, Ind AS 8. What Ind AS 8 deals with? Change in accounting policy. How do you account for it? Suppose you changed an accounting policy in the year 2021-22. Beta, neutral for management intent means management is the one who prepares the financial statements, right? Who prepares the financial statements? In your audit report, you write, no, the management's responsibility. The management is responsible for preparing the financial statements. So when you say neutrality is for management, definitely it is, because they have to be neutral in preparing the financial statements. And that is why it comes under the financial statements. Okay. Now coming to 21-22 year, you have changed your accounting policy. You have changed your accounting policy. So when you changed your accounting policy, that is, you moved from cost model to, let us say, a revaluation model, because you thought that it is going to give me a better presentation. Can you do that? Yes. But when you do this change, you will have to make a retrospective change in 2020-21 also. Why are you making a corresponding change in 2021? To facilitate comparison. To facilitate comparison. Sir, wo kaise? Suppose you have followed the revaluation model in 21-22 and you have followed the cost model in 2021 and you don't make any change. Then what is going to be happening? Assets of 21-22 will appear at revalued figure. 2021 will appear at cost. Where is the synchronization? Depreciation of 2021 will be based on cost. Depreciation of 21-22 will be based on revalued figures. Where is the comparison? There is no comparison. You cannot compare because the things are not similar. And therefore, when you have an accounting policy change, the change is retrospective. The change is retrospective. That means what? You will move backward and present the change. You will move backward and present the change. This is when you are changing your accounting policy. Next one, Ind AS 1, disclosure of accounting policies, right? You disclose your accounting policies. Now, when you disclose your accounting policies, suppose you are following a particular manner of revenue recognition. You are Airtel Limited, okay? And on the other hand, you have Vodafone Idea. You disclose your accounting policies. How do you depreciate property, plant and equipment? You follow, let us say, straight line method. Whereas Vodafone Idea follows WDV method. Whatever be the method, different methods are being followed. Or you follow cost model. Vodafone Idea follows revaluation model. So when you are comparing the financials of Airtel and Vodafone Idea, you know that certain things are not comparable because of different accounting policies, which you are disclosing. So therefore, you have the requirement of retrospective restatement of financial statements in case of change in accounting policy. Why is that there? That is there to facilitate comparability. That is there to facilitate comparability. Comparability means what? Comparability means comparison between two companies for the same year, or comparison between various years reporting periods of the same entity. So current year, previous year. Why do I give current and previous year? To facilitate my comparison. To facilitate my comparison. Why do I disclose my policies in so much detail? Obviously to know what I'm doing. But the second important reason is when I compare across entities within the same industry, I can compare my policies with their policies and arrive at a conclusion. So these, what you can say, these treatments in the respective Ind AS, they are all meant to meet the enhancing qualitative characteristics of comparability. Okay. Then you move on to verifiability. It is an enhancing. characteristic. It's not mandatory that you should have verifiability. Mandatory are only two: relevance, faithful representation. That's it. ये सब चीजें हो सकते नहीं हो सकते, it is still fine, but those two are mandatory. You have to ensure that. Verifiability means what? Your information should give a basis of verification, if possible. If possible, your information should give a basis of verification. That means an investor should be able to verify what you are reporting. Okay. Just making it up, but just giving you an example. In your balance sheet, you are given bank balances. Can somebody verify the bank balances independently? Yes, he can. He can go to the bank, request for the bank. I told you it's a hypothetical example. Go to the bank, request the bank statements, compare and see if there is a difference. Ask for the reconciliation. This is what is verifiability. Verifiability could be direct, like what we have discussed. It could be indirect. That means, suppose for inventory, you are following the FIFO model. Then look at the inventory, apply the cost formula. Your value and the value disclosed in the financials should be the same. So that becomes verifiability. That becomes verifiability. Okay. Now, timeliness. Timeliness means presenting information punctually. Dekho, what was the last date for filing your tax audit report now? It was 15th Feb. Imagine a company, a listed entity, forget listing regulations for now. Okay, forget listing regulations, forget everything. The deadline was 15th Feb. Tell me, as an investor, 31st March 21 ka figures, 31st March 21 figures, if you get the balance sheet signed on 15th February 2022, do you think that information will hold any relevance to you now? You will tell, sir, 31st March 22 is coming after 1.5 months. Why are you presenting this information also? This has become outdated. वो तो past हो गया. You are doing a regulatory compliance of presenting the data, but this data is irrelevant for me. And therefore, timeliness means you have to present your information within specified periods of time. That means you will have to present the data within the time that it remains relevant. So whenever you see the listed companies, they present their financials within April or May. That is much relevant. That is much relevant. Even certain companies like private limited companies, public limited, unlisted companies, by July, August also when they present, it is still timely. But October, November, December, Jan, Feb, when you come to, it loses all significance. Your financial statements, they are not meaningful because they are not timely. Lot of water has flown under the bridge and then you are presenting the data. It does not carry any significance. Okay. So Tota Sharon Kumar has a question. Does the management ensure that financial statements give these essential qualitative characteristics while preparing, or is it something that the conceptual framework saying all financial statements in default have these characteristics? The framework tells by default, you have to follow this. Management has to ensure that it is followed. That's it. But this is mandatory. If substance over form is not followed, what will be the impact? Information is not faithfully presented. And when information is not faithfully presented, what will be the next impact? The auditor could qualify his audit report, right? So therefore, faithful representation is what should be inbuilt in your financial statements. Okay. The conceptual framework is just giving the necessary importance for that. So relevance and faithful representation, by default, it should be there. Why? Because the conceptual framework has specified it. Do the management have anything to do in this regard? They have to ensure that they comply with that particular essential characteristics. Okay. So I hope I have addressed that. And finally, understandability. Abhi, understandability is a little bit of a trick. Okay. Look at India's financials. Do you think any XYZ investor will understand India's financials? He won't. So the important part of understandability is this. Financial reports are prepared for users having a reasonable knowledge of business and economic activities, and you review and analyze the information diligently. You prepare balance sheet P&L, and a chemistry professor comes to the company and says, what have you prepared? I invested in your company and I did not understand anything from your balance sheet. What are you going to tell him? Beta, you don't understand because you are an illiterate in reading the financial statements. But you can go to somebody who understands Ind AS and understand from that particular person. So financial reports are not prepared for any XYZ person. No, it is prepared for the users who have a reasonable knowledge of business and economic activities and who review and analyze the information diligently. Matlab kaun? Analysts, people like you and me who can understand the financial information. Many times even we do not understand what is treated in a particular, how a particular thing is treated in my financial statements because of the complex nature of my Ind AS framework. That point of time, so it is given here, at times even well-informed and diligent users may need to seek the aid of an advisor to understand information about complex economic phenomena. Okay, so this is what is given to you. You cannot say, sir, Ind AS bana ke kya fayda? What is the advantage of Ind AS when my financial statements have become more complex, more difficult to understand? What it is? Sir, you are not preparing financials for any person. You are preparing for people who understand what it is to read a financial statement. Yes, and therefore these are my 4 enhancing characteristics. As far as possible, try to follow this, but if it is not possible, it's okay. But are you mandated to follow the 2 essential characteristics? Yes, you have to. Management should ensure that they follow relevance and faithful representation of information always. Okay, so that takes care of your basic and enhancing characteristics. The cost constraint is always important in financial statements. Cost constraint. Cost constraint means what? You have to report a particular transaction in a particular manner. But deriving that information is taking a lot of time, lot of economic resources. So now the question arises, you have to strike a balance between, on one side you have reporting, on the other side you are having cost. If cost goes very high and the benefit from that reporting is very less, you have the option to say that it's not justifiable. It's not justifiable. So so you have to ensure that there is a balance between the cost and the financial information that is presented. By giving this data, by spending so much of cost, is it really making it relevant and faithfully representing for the user of financial statements? And what is the cost that they will incur to understand it? If both the sides, the cost is far high as compared to the benefits from the reporting, you as an entity will have to take the cost. You have to take the call. Okay, whether it is, cost is always a pervasive constraint. Okay, when your business models change, your elements change. When your elements change, you will have to then decide whether I need additional expert to prepare my financial statements. If yes, then the remaining disclosures follow. Okay, so cost constraint is always going to be there. Is it okay? Yes. Yes, all clear so far, guys? Any doubts? It's theory. You may get a little bit bored, but please bear with it. I'll try to introduce examples wherever I can. Namita, Sairam, Tota, Sharon Kumar, Suraya, Srinidhi. Have you guys understood so far? Crystal clear. Yes. Any other answers? Feedback? Lot of speaking is there today. All good to go? Okay. Now, what are financial statements and who is the reporting entity? Okay, so this is what are you going to disclose. So this is standard: asset, liabilities, equity, income and expenses. That is useful to assess the prospects of future cash flows, management, stewardship. Such financial information is provided in the balance sheet, P&L, statement and notes. All these things you are aware of. Nothing new in this. Okay. What do you mean by reporting period? They are prepared for a specified period of time. See, your entity, this is CA foundation concept. Okay. Entity is generally a going concern. That means वो चलता रहेगा, it will go on continuing till the end of time. Okay. And when it continues till the end of time, you have to understand, where am I going? Am I making profit or not? So you will report financial information, or that is your balance sheet, P&L, cash flow, etc. for a particular period. This period is known as a reporting period. See, remember, we are doing conceptual framework for reporting. We are not doing conceptual framework for Companies Act or for Income Tax Act. We are not doing that. Companies Act requires financial year 1st April to 31st March. Income Tax Act also follows the concept of financial year. But the framework does not say anything. It could be something like 6 months financial statements. You will say, no, I want my investors to be up to date. You can give a 3-month financial information. You can give a monthly financial information. You can give a 12-month financial information. You can give an 18-month, but it should be reasonable. It should be reasonable. Okay. So therefore, the framework does not prescribe कि वो financial year ही होना है. The framework does not prescribe that. It could be any duration, but it should make sense. Okay. And the duration comes from Companies Act. It comes from Income Tax Act. Have you understood? So that is the concept of specified period of time. That is the concept of specified period of time. Okay. Information about future transactions and other possible future events. Okay. Coming next. Financial statements. Financial statements are generally past information presented today. Past information presented today. That means what? Events ho chuke hai. Transactions have already been incurred. Events are done. Transactions are incurred. All the financial impact is done, and you are reporting it. So it is generally past information presented today. However, that means what? These are not forward-looking. These are not forward-looking. That means what? What will happen in the future, you will not see in balance sheet, P&L, cash flow statement, notes, SOC, etc. Nahi dikhte. But does it mean forward-looking information is excluded from financial reporting? Answer is no. Yaad karo, Ind AS 10. Events after the reporting period. Events after the reporting period. 31st March 2021 is your reporting date. 31st May 2021 is the date your financial statements are authorized for issue. If there is a significant event that happens after 31st March before 31st May, what does it become? It is covered under Ind AS 10 as events after the reporting period. Suppose in this period, a debtor went insolvent. What do? You adjust the balance of debtors on 31st March 21. So that becomes a forward-looking information. That becomes a forward-looking information. Suppose a big fire happened after 31st March 21. What do? Sir, I give a disclosure. That disclosure makes it a non-adjusting event. So can I strictly say it is not forward-looking? Answer is no. You present certain information if it enhances the, what you can say, if it enhances the faithful representation or relevance to the user of financial statements. So you are having the concept of adjusting event, which means that certain forward-looking events can be given effect to. Certain events cannot be given effect to, non-adjusting events, in which case you have to make a disclosure. So to that extent, it is a forward-looking scenario, a forward-looking presentation. Next one, value in use. Value in use, a concept under Ind AS 36. Ind AS 36, impairment of assets. Value in use, present value of discounted cash flows. Now, value in use, present value of discounted cash flows, when you have, what do you do with that? You explain how you got the value in use. And when you explain how you got the value in use, you will have to give your estimate of the future cash inflows, including the disposal value. So that is something which you are estimating, which is a forward-looking figure. And therefore, you will probably give that in your notes. And to that extent, you are giving information about the future. You are giving information about the future. Is it okay till now? Yes. Have you understood? All clear? All clear when I talk about reporting period and forward-looking financial statements. Okay. Information about possible future transaction is included if it relates to the entity's assets at the end, or that existed at the end of the reporting period. We will not look at something which is not there in the entity and you are still reporting it. No, you cannot. Okay. What is there in the existing financials, relating to that some future event has happened, you will disclose it. You will adjust it. So to that extent, yes, forward-looking events are given. Forward-looking transactions are recorded. Okay. All right. Financial statements do not typically provide other types of forward-looking information like expectations about management strategies, etc. All those things you will not find in the financial statements. Okay. Financial statements include information about transactions and events that have occurred after the end of the reporting period, if providing the information is necessary to meet the objective. So this is your Ind AS 10, events after the reporting period. Okay. Going concern assumption, perspective adopted. Okay. Now the question is, who is my reporting entity? Who is my reporting entity? Yes, come on. Now I need your answers. Who do you think is the reporting entity? You have done so many balance sheets, profit and loss accounts. Who is my reporting entity? Chalo. Please interact. Okay. I'm feeling it's getting monotonous, but so that is why please interact. What do you understand by the term reporting entity? who presents the financial statements, the company. So Naveen Prakash, Sai Ram and Sarika Sharma, who presents the financial statements. That is true. Utna to mere ko bhi malum hai. But now let me build it on. Who is required or who elects to present financial statements? Who elects to present financial statements? Elects matlab chooses. He may not be required to present, but if he chooses to present, that will also be a reporting entity. I got an answer from Sairam that it is a company, and the same was with Naveen also. So they spoke about a company being a reporting entity. So can I say that it includes legal entities? Legal entities means what? Entities which are recognized in the eyes of law. Entities which are recognized in the eyes of law. Okay. Can I have a non-legal entity? Can I have a non-legal entity presenting financial statements? What do you guys think? An entity, okay, so Suraya is also right. Entity who prepares and presents the financial statements. Reports first to BOD and then it is made for the shareholders. Yes. Directors are not a reporting entity. You don't prepare the balance sheet P&L of the director individual. You prepare it of the company. Okay. So they are the preparers, if I have to say. Okay. They are the preparers. The question that I'm now asking is, can I, non-legal entity, present financial statements? No. Anyone can is not the question. My question is, it is not legally recognized. See, I am a legal entity, right? Because I have my own identity. I have my PAN card. I have my Aadhaar. So I am a legal entity today. You are a legal entity today. There is no legal entity. Can that entity, that entity is not legally recognized. Can we have financial statements of such an entity which is not legally recognized? Yes. When you say anyone can, I'm assuming you are saying it is a legal entity. So correct, Namita, correct. An individual, is he a legal person? Is he a legal person? So इस case में individual also will come, LLP also will come, AOP, BOI also will come, firms also will come. Why? Because all of them are legal entities. I'm not going into separate legal entity or not. Okay, I'm saying that individual, LLP, AOP, BOI, firms, all of these have a particular legal status. So company के साथ individual, LLP, AOP, BOI or firms are all specific legal entities. So when they prepare the financial statements, it is nothing but legal entities preparing the financial statements. My question is, come out of your understanding of the legal systems and think, do I have a non-legal entity that presents the financial statements? Come on. You guys know this answer, okay? And when I tell the answer, you will be, oh. Okay, so Srinidhi, can you give an example of a non-legal entity which presents the financial statements? Srinidhi said, yes, even a non-legal entity can present. AJP, AOP, artificial and juridical person. Yes, but it is a person recognized in the eyes of law. It is a person recognized in the eyes of law. Okay. See, don't draw any conclusions. I'm giving you an example. Ayodhya, the deity of Lord Ram, is a person today. It is a legal entity today. right? So Lord Ram's financial statements, can it be prepared? It can, because it is a legal entity. My question is, non-legal entity, can it present the financial statements? You have to give me this answer. Okay, you have to give me this answer, otherwise all my teaching has gone as a waste. Okay, Sumit Jain, a trust, definitely. But trust has a legal backing to it. Trust has a legal backing to it. There is a trust deed. It again becomes a legal entity. It again becomes a legal entity. I think my question is not, they can present. But who are they? Who is a non-legal entity? I think I'm not able to convince groups which comprise of parent, subsidiary. This whole financial statement is presented as one single entity. Yaad karo, Ind AS 110. Consolidated financial statements. The financial statements of the parent and the subsidiary are presented together as one single entity. Now, is the group legally recognized? Answer is no, it isn't. It's not a legal entity. You will typically not have any action that is taken on a group, because group का कोई legal status ही नहीं है. There is no legal status for a group. There is a legal status for the company. There is a legal status for the subsidiary. But for the group, there is no status. Okay. Let me build it up again. For the parent, you are having a corporate identification number. For the subsidiary, you are having a corporate identification number. You will be having its PAN number. Okay. But for the group, when I club it, this group, does it have a corporate identification number? No. Does it have a PAN number? No. Will assessments happen on the group? Answer is no, it won't. Will MCA take action on a group for any reporting errors or something like that, for any investigation? No, not on the group, but on the company. So the group is not a legal entity. The group is not a legal entity. And in spite of that, I prepare a balance sheet P&L, which I refer to as consolidated financial statements, Yes. So Pradeep, I hope you understood. Yes. So Srinidhi, branch or a segment? Yes, I'm coming to that. But before that, did you understand this part? Yes, that is why I was saying that you should think beyond the horizon of Companies Act, Income Tax Act, etc. So these two entities, parent and its subsidiaries, club their information and present it as a single entity. Acha, why do we have to present CFS? Can anybody give me the answer now that you know? Why are you presenting consolidated financial statements? Particularly those who have studied CFS already. Why do you think CFS is mandated? Or why do you think CFS is required? Or why do you think entities prefer CFS? What is the reason? What is the reason? Why is consolidated financial statement? Why are consolidated financial statements prepared? Don't tell me mandated by law, etc. Logically give me the answer. To provide true and fair view on the CFS. No. It's not like that. Okay. So Medjan, it's not like that. Rather, okay, true and fair view, yes. But you are speaking as an auditor. Okay. Now just pay attention. Reliance Industries Limited, I'm doing a simple T-form balance sheet. Okay. Equity share capital, PPE, current assets, investments, Jio, Reliance Digital, and Hamleys. This is the balance sheet of Reliance Industries. And then I will be having P&L of Reliance Industries. Sales, expenses, tax, net profit. Simple balance sheet. Okay, correct. Now you are an investor of Reliance Industries. Do you think this data is going to give you an adequate idea of what your investment represents? It doesn't. Why? Because in your equity share, there is also a proportionate effect of Jio's holdings, Reliance Digital's business, and Hamleys. Your equity, you as an investor will get a better representation, better information, more relevant if you consolidate. Dekho, ultimately you have subsidiaries probably to ensure expertise flows to each company independently. But ultimately the investor who has invested in Reliance is also an indirect investor in Jio, Digital, and Hamleys. So he will be concerned about what is the operation of those entities also. So what do I do is Reliance Industries Limited consol financials. In consol, what am I going to get? PPE, current assets of the group as a whole. Then equity share capital, reserves and surplus. I'm just preparing a normal T-form balance sheet. Don't tell me that, sir, aapka balance sheet in days ke hisab se nahi hai. Right now, I'm not discussing that. Okay. And when I do the P&L of the group, what am I going to get? I'm going to get the total revenue of Reliance Industries plus Jio plus Reliance Digital plus Hamleys. Expenses entire, tax expense entire, and that gives me the net profit. That gives me the net profit. And now the equity shareholder of Reliance, will now say that with the help of CFS, I can exactly understand how much profit has been generated by virtue of what you can say, what is the actual profit per share that I am holding in Reliance Industries Limited. So EPS is important for a shareholder. So EPS, true EPS comes from where? CFS, because his investment represents some investment of Digital, some investment of Jio, some investments of Hamleys. So therefore, you are going to get a complete idea. You are going to get a complete idea of the entity. So therefore, that's right. Now I'm having the answers. to give the investors the picture of the whole group. Namita, that's right. Tota gives information about all the companies where they are invested. That is right. Suraya has said to understand the financial position of the group as a whole, the effect of subsidiary on the group's performance, right? Info about businesses so that investors come to know how the group is performing. And what fundamental characteristic are you meeting by this reporting? I meet the characteristic of relevance, because each of these groups are relevant to the equity shareholder in Reliance. See, when Reliance incorporates a subsidiary, it is investing in the subsidiary. Investment means whose money they are investing? Equity shareholders' money they are investing. So when they invest the equity shareholders' money, what does it mean? It means that they are channeling the money into somewhere else. So the shareholders can always say, अगर मुझे पैसे दिए होते, if you are forming a new company, I will invest directly. Then he will say, no, वो हमारा ही company है. It is a fully owned subsidiary or a subsidiary, and we will present to you the financial statements consolidated. Why are you presenting? So that the investors get a true picture of their performance, of their shares performance, of the wealth that they have generated. And therefore, CFS meets the criteria of which criteria? The two criteria of relevance as well as faithful representation. Each and every Ind AS, you will see that these two criterion will always be met. Is it okay? Have you guys understood? Yes. So therefore, entities related to each other by way of a parent and subsidiary relationship prepare their financial statements. These are known as consolidated financial statements. The group is not a separate legal entity. In spite of that, they prepare the consolidated financial statements. Is it okay? Yes. Correct. That's right. Okay. Have you guys understood now? So when I talk about non-legal entity, specifically it means groups. All clear? The last part of this topic, that is reporting entity, and then we shall take a break. Okay, then we shall discuss elements, measurement basis, etc. Okay, so we'll just discuss the last part. Until now, is it clear? So who can prepare the financial statements? What do we call that entity? That entity is known as the reporting entity. It could be legal entities, it could be non-legal entities. Legal entity present what we call as standalone or separate financial statements. Standalone or separate financial statements, which is what you and I have also heard in Ind AS 27. So we call this as standalone or separate financial statements. Non-legal entities connected by a parent subsidiary relationship. Connected by a parent subsidiary relationship. What do you prepare? Consolidated financial statements. This is Ind AS 110. Acha. Can I prepare? The last question now. The last question. I don't expect you to answer this, but if you answer, because why I don't expect is not because it is a personal comment, but because we don't see such things in India. Okay, but I'm just hopeful that you will answer. Can I have a situation where non-legal entities, not connected, non-legal entities, not connected by any relationship, can these entities prepare combined financial statements? If yes, who are such entities? Who are such entities? Who are such entities? Okay. Tell me. I give you 1 minute to think. Okay. I don't expect, but if you can think, I will be very happy. Okay. I'll wait for a minute or two. And because this combined financial statements is something which you would not have prepared so far. In the Indian context, वो कभी रहता नहीं है. Okay. Foreign company. Okay. Foreign company becomes a separate entity, right? So that is a legal entity. I'm talking non-legal entities not connected by any relationship. Okay. Let me explain with the help of an example. आपको समझ में आ जाएगा. You will understand. Okay. This is not there in, I mean, I have not seen it in the Indian scenario, but this is more common in foreign scenarios. Okay. See, you guys remember there was an appendix to Ind AS 103. You guys remember this common control combination? Yes. Do you guys remember this common control combination? Yes, sir. We remember it. Okay. Common control combination is a carve in. I had taught you the very first day when I explained in the live session. Later on in the recorded session, we did common control combination. This is a carve in. But carve in means it is not there in IFRS. It is not there in IFRS. So suppose I have Mr. A who has company X, company Y, company Z. These are all one-person companies. These are all one-person companies. So each of them are separate entities by themselves. This is in the telephone business. This is in the cable optical fiber business. This is in the internet service provider business. His business is increasing multiple what you can say, leaps and bounds. And therefore, he decides to come out with an IPO. He decides to come out with an IPO. And when he decides to come out with an IPO, he says, let me combine all these entities as one single entity and let me come out with an IPO. So what he will do is, for the purpose of IPO, he will present the first set of financial statements prior to coming out with an IPO. He will combine the financial statements of companies X, Y, and Z. In the Indian context, remember, in the Indian context, common control combination is there. Foreign mein, where IFRS is actually there is no concept of triple C. Triple C is purely an Indian concept. Triple C does not exist. So don't tell me these are CFS. These are not CFS because this is a foreign concept. Okay, ye banda foreigner hai. Okay, he's a foreigner. Okay, see, we have drawn the things from there. But you should have seen whether we do it our side also or no. So companies XYZ present something known as combined financial statements. This is not consolidated. Consolidated is when it is a parent subsidiary relationship. This is a combined financial statement. That means what? You are combining XYZ's assets, liabilities, etc. Why are you combining? Because all three of them are controlled by Mr. A. It is a triple C in Indian context. In foreign concept, it's not there. But this company wants to come out with an IPO. And therefore, to help the prospective investors understand the assets, the liabilities of the entity, we will prepare something known as a combined financial statement. This combined financial statement of X, Y, Z is not a separate legal entity. It is not a separate legal entity. Okay. Likewise, if I further build up on this, Mr. A is owner of company X and company Y. Mr. B is owner of company Z. Now, can you combine? Yes, you can combine. It won't be a triple C also, but then also you can combine the financials and present the data to prospective investors for the purpose of investment. So X, Y, and Z together will join hands and present something known as combined financial statements. So combined financial statements, where do you see it? Normally for IPOs, for spin-off, for private, private acquisitions or private fundings, you get to see these kind of combined financial statements. India mein it's not there specifically. I have not seen it. Okay, I'm not saying legally it's not possible, but it is typically common in foreign companies. Why common in foreign companies? Because foreign companies don't have triple C. Here we have triple C. So therefore, XYZ would be consolidated under triple C here. However, it's not there. So it is a foreign concept. So combined financials, India mein it's very rare. Foreign also it's very rare. But because it is a concept, I have to explain it to you with the help of an example. Nahi to kya karte? Aap ratta maar ke aa jate and then you would not understand it. So who is a reporting entity? An entity that prepares financial statements, prepares and presents financial statements. It could be a legal entity, in which case it will present a standalone or separate financial statements. It could be a non-legal entity. Arey, please don't say non-legal as illegal. Okay, आपका कोई भरोसा नहीं है. Non-legal को illegal entity बोल के आओगे, आपके आंसर ही इलीगल हो जाएगा. It is not an illegal entity. It is not a legal entity. Okay, but they are connected by parent subsidiary relationship. So then you prepare consol financials. If it is not connected by any relationship, then you call them as combined financials. When you combine it. Okay, and then finally, Srinidhi has said somewhere, I think it was Srinidhi, who said branch or division. Yes. So reporting entity could also refer to as part of an entity. Part of an entity. So for example, you have a foreign branch situated in London. Now, for the purpose of return filings of London, that entity will have to prepare financial statements as per IFRS. Is it a separate legal entity? Answer is no, it isn't. But will it prepare the financial statements? Yes, it will. So will it become a separate, will it become a reporting entity? Yes. So in this case, branch also could be a reporting entity. Sir, why Mr. A and Mr. B, being separate persons, prepare combined financials? They decide to join hands. They look at the synergies between themselves and they say, chalo hum log haath mila ke dhanda aage karte, we'll do our business together. So they join hands, present combined financial statements and come out with an IPO. Okay, so that is the reason A and B, though they are separate, they decide to come together. Is it okay? Have you understood the concept till now, everyone? Are, have you understood? Some people, Kanika is fine. Sarika, are you fine? Affiliates, network, all of these absolutely right. These become your non-legal entities which are not connected by any relationship. Okay. Any industry required to prepare financial statement of respective companies in the industry? I didn't understand this. Tota, just let me know if you can clarify me on this. No doubt, Priya has confirmed, Tota has confirmed, Kanika has confirmed. Yes, okay. All right. Namita, are you there? Suraya, are you there? Sai Ram, Srinidhi, all clear so far? Yes. All clear. Okay. So we take a 5-minute break. It's 8:55. We reassemble at around 9 a.m. Yes. We take a 5-minute break and continue. Okay. Okay. All right, guys. So welcome back. So we have so far discussed the characteristics of financial statements. What do you mean by reporting period? Forward-looking data also can be presented in some cases. And who is my reporting entity? So these are the things we have already discussed so far. Okay. Now you come on to the topics like elements of financial statements, and the topics now start to get interesting, as well as at the same time they are something that you already know. So what are you going to give information in your financials? Well, you are going to give financial position and effects of transactions and other events. So the first thing is economic resources is the first information that you are going to give, which we call as an asset. So what is an asset? It is a present means it is existing today. It is a present economic resource. It is a present economic resource controlled by the entity as a result of past events. So there is a resource. That resource is controlled by the entity as a result of past events. And what is the meaning of economic resource is defined here. An economic resource is a right that has the potential to produce economic benefits. Okay. You remember there was a definition of asset. There was a definition of assets under the previous reporting framework. Conceptual framework के पहले एक और framework था. We used to call it as framework for presenting and reporting in accordance with Ind AS. Under that, what was the definition of assets? The definition of asset was it is a resource that is controlled by the entity. That is controlled by the entity, and it is probable that economic benefits, resources embodying economic benefits, ऐसा word था, and probable that economic benefits would flow to the entity, So this was the definition of assets earlier. Okay. This is as per old framework. Now look at the new framework. Okay. What is the definition of asset? It is a resource, an economic resource. So this part is the same. It is controlled by the entity as a result of past events. So this is also same. And then it moves on to define what is a resource. Resource is a right. It is a right that has the potential to produce economic benefits. Having potential to produce economic benefits. Okay. So now the important thing that is there is right, potential to produce economic benefits. So first important thing is right. Second is potential to produce economic benefits. And the third important part is control. So these are the three things which are very, very important to understand when an item can be called as an asset. In the earlier framework, what was important was resource, controlled, and probable. So what is the underlining difference? The underlining difference is in the earlier framework, it should have been probable that economic benefits would flow to the entity. Only then you would recognize asset. This was what was mandated under the earlier framework. In the new framework, it is sufficient if you have a potential. Probability can be very low, probability can be very high. That affects the measurement of the asset, but it remains an asset. Okay. And therefore, probability is removed in the new framework. It's not necessary that it should be probable to get economic benefits. Meeting the potential was sufficient. Sir, difference to theek hai, but we did not understand the implication of this difference. Okay, let me explain with an example. आजकल बहुत एयरलाइन का एग्जाम्पल ले रहे हैं, बट ठीक है. SpiceJet is a customer of IO, Indian Oil Corporation. For what? Aviation turbine fuel. All my examples are stories. You understand the stories, you will be able to understand the concept. SpiceJet के बहुत खराब दिन चल रहा है. SpiceJet is not performing well. Okay, touchwood, it is performing well. Okay, this is a story. Okay, SpiceJet is not performing well. IOCL had sold ATF to SpiceJet. So therefore, technically, SpiceJet is a debtor and IOCL has to collect money from SpiceJet. Okay. Now, under the old framework, abhi dekho, under the old framework, when could you recognize the asset? When it is a resource. Is it a resource? Yes, it is a right to collect cash. Is it within the control of IOCL? Yes, the receivables are within the control. However, was it probable that you would recognize the cash would come to IOCL? Answer is no, because SpiceJet is not performing well. So what was the problem in the earlier framework was, technically speaking, this would not meet the definition of an asset. And therefore, if you had earlier recognized it, you would de-recognize it in accordance with the framework. But Ind AS 109 on financial instruments required you to follow the expected credit loss model and provide for the losses that you expect in the future. You are not de-recognizing the asset. Under Ind AS, you are not de-recognizing the asset, but what were you doing is, you would create a provision for expected credit loss, and that would be a fairly high provision, which is okay. You are following prudence concept. That is fine. But now can you see that in earlier case, it was not an asset. Under the old framework, this debtor was not an asset in the first place. That means initially when it was probable, you recognize the asset. The moment it is not probable because SpiceJet performance has gone down, net worth is negative, it has even say filed for liquidation, then though it is not sure that you are going to get the money, not at all probable. So therefore, what the framework required was, you cannot show it as an asset. In spite of that, Ind AS said, no, we will show it as an asset and we will follow the expected credit loss model and provide for the expected credit losses. The losses can go up to the amount of the trade receivable, no problem. But we will show asset on one side and below that we will show less provision for expected credit losses. To that extent, there was a conflict. Why? Because on one side, Ind AS 109 recognizes this asset, but the framework tells you it cannot be an asset because the probability criteria is not fulfilled. To meet this conflict, the words have now been changed to having the potential to produce economic benefits. वो कितना छोटा benefit क्यों ना हो, it doesn't matter what is the quantum of benefit. Suppose SpiceJet is a debtor for 100 crores, and out of that, based on the credit loss model, IOCL expects that only 2 crores is recoverable. Doesn't matter. Does it have a potential to give you 2 crore rupees? It has. So it is an asset. Probability is not concerned. We are not concerned whether 98 crores will come to me or not. Why go even one step further? SpiceJet files for liquidation. In spite of that, do you have the right to collect the money on sale of the assets of SpiceJet? Yes, in the liquidation nomenclature, after regulatory authorities dues, after employees dues, after secured creditors dues, you will then come to unsecured creditors. If there is some payment, some assets left to meet the dues of unsecured creditors, those dues some portion will come to you, that is IOCL, which is the company that recognizes SpiceJet as an asset. So can you continue to recognize the asset under the new framework? Yes. And therefore, ye jo conflict tha, this conflict which existed is now deleted by virtue of this change, when probability has gone and potential has come into existence. We are now focusing on potential. As long as my resource has the potential to produce economic benefits, I can recognize it as an asset. Doesn't matter whether it is a very high probability or a very low probability. It really doesn't matter. It can be an asset. Sir, but probability is very low, very, very low. It is not at all possible. It is remote. Can we still recognize an asset? Then go to the respective Ind AS. Ind AS 37, contingent assets. Do you recognize contingent assets? No, because the flow of economic benefits is not probable. It is just possible or even below possible. So what do? You disclose the contingent assets, but you show it in the notes to accounts. So it is an asset. You are not showing it in the financial statements. Financial statements is not only the balance sheet P&L. It also includes your notes. And in the notes, you are disclosing the contingent asset. And why are you disclosing? Because it meets the definition of asset. Suppose your aeroplane got damaged in fire and now you are filing a claim for insurance. Now, is the insurance claim your resource? Yes. The policy is your resource. Is it controlled by you? Yes. But you do not know how much is going to come to you. Sir, that is a measurement aspect. That is a measurement aspect. I do not even know if my claim will be passed. Doesn't matter. Thoda to aayega, something will come. You have an asset on your hand. Yes. Recognize that asset. If it is very remote, show it as a contingent asset. If it is probable, recognize the asset. But right now, the concept of probability has totally vanished from the conceptual framework. Have you guys understood the anomaly that existed? Have you guys understood what was the problem with this earlier definition? It focused on probability. Matlab, no probability, no asset. Arey, how can that happen? Trade receivable is a right to collect cash. Abhi probability hai ki nahi hai? Whether there is a probability or not, I am not concerned right now. I have a right to collect cash, so it is my asset. I may be able to collect full, half or 10%, doesn't matter. It is my right. So it is an asset. There is a potential to get economic benefit therefrom. And therefore, I will recognize such a trade receivable, which is supposedly going bad, still as an asset in my books. And as per the provisions of Ind AS 109 related to financial instruments, I will make a provision for expected credit loss. But that is an Ind AS specific requirement. If company doesn't know SpiceJet is going to liquidate, that time, it has to know. You will obviously know what is the status of your customer, no? आपको पता रहेगा, you will come to know what is the status of your customer. So you cannot say you don't know the status of your customer. You do an audit, you raise a bill on your client, you know whether your client is going to pay you or not. Yes, वो पता चल जाता है. You know that at the time of what you can say, when you raise a bill, and subsequently the events, you will come to know what happens. Okay, you will come to know. So therefore, you cannot say that I don't know whether my customer goes into liquidation or not. Liquidation is a very, very serious thing to happen. It cannot happen just by hiding from the world. Okay, company goes into liquidation means sabse pehle the world will come to know. The first thing is the world will come to know. The customers, the creditors, the lenders, the investors, the employees, everybody will come to know. Okay, so it's not something that is going to remain unknown. Okay, but I hope you understood what is the anomaly that existed. Acha. Now, it is very interesting. It is very interesting right now. You see now, new framework. New framework. What is an asset? An asset is a resource. An asset is a resource that is controlled by the entity. Okay. Controlled by entity. And then you come to the next part. What is a resource? A resource is a right that has the potential to generate economic benefits. That has the potential to generate economic benefits. All right. Yes, yes, yes. Okay. Now we move on to one standard which you have already studied, that is Ind AS 38 on intangible assets. Now you come to intangible assets. What do you mean by an intangible asset? If you look in intangible asset, this is the anomaly. The term asset is defined as a resource controlled by the entity. Intangible asset, resource controlled by entity, probable that economic benefits will flow. Probable that economic benefits will flow to the entity. And now you again see, now there is a new conflict here. Now there is a new conflict here. Okay. Ind AS 38 vis-a-vis the old framework. Vis-a-vis the old framework. Here there was no conflict. Why? Because the old framework focused on probability and the intangible asset definition also focused on probability. The new framework talks only about potential, whereas Ind AS 38 talks about probability. So here it is potential now, whereas in the Ind AS it is probable. So now again there is a conflict. Again there is a conflict. And now the question arises, sir, will we have a third framework? No, you won't. Sir, this is inconsistent. This is not inconsistent. This is not inconsistent. You remember, Ind AS 38 has very, very stringent requirements to recognize intangible asset. Why? Because it is something which you cannot see in the first place. So when you cannot see, the requirement of generating economic benefits should be extremely high. Should be extremely high. In fact, Ind AS 38 goes one step ahead and says any intangible asset, the probability criteria is deemed to have been fulfilled. If you read Ind AS 38, the probability of economic benefits flowing to the entity will be deemed to have been fulfilled in the case of Ind AS 38. This is given in the definition of internally generated intangibles. When you are producing a software, when you are producing a vaccine, the scientific know-how that you generate, it is deemed to have economic benefits. You will not check it for whether the probable benefits will flow or not. It is deemed to be probable that economic benefits will flow to the entity. This is what Ind AS 38 has assumed. And Ind AS 38 specifies that an intangible asset is a resource which cannot be seen, which cannot be touched, which is not a tangible asset, which is controlled by the entity, where it is probable that benefits will flow. Whereas the new framework tells asset is a resource which has the potential to generate economic benefits. Is there a conflict? It's not a conflict. Is there an inconsistency? It's not an inconsistency. The Ind AS on intangible assets is requiring more stringent recognition principles, more stringent recognition principles, more specific. Framework gives a general guideline. Framework gives a general guideline, whereas Ind AS 38 has given you a specific guideline. And as we all know, specific always overrides the general. And that is why we don't view it as an inconsistency. We will view it as specific versus what you can say general. Specific prevails. So Ind AS prevails. That's right. That's right, Suraya. Okay, so we never focused much on the framework, right? In fact, the framework is the bedrock of all your Ind ASs. Okay, so now this is what is there about the definition of an asset. This is what is there about the definition of an asset. moving forward, let us now move forward. When you talk about asset, present economic resource. Okay. So when we talk about asset, it is a present resource. And resource means what? It is a right that has a potential to generate economic benefits. Okay. Now, these rights could be counter obligations. They could be counter obligations. For example, debtor creditor, borrower lender. Yes, debtor creditor relationships, borrower lender relationships, or you have given advance to supplier and you have a right to receive the material against that. So all these are counter obligations. You recognize an asset, somebody else recognizes a liability for the asset that you have recognized. This is known as counter obligations. So one thing is, this is your right. Second, can I have a right without counter obligations? Can I have a right without counter obligations? Definitely you can have. You own property, plant and equipment. You have the right to sell it, to use it, to break it, to burn it, to destroy it, to dismantle it, to reassemble it, to give it on rent. You have the right to do anything and everything with this PP. But is it an obligation for somebody else? No, it's not. Asset aapka hai. It's your asset. You paid for it. You fulfilled your obligation. He got his money. Now with this PP, you can do anything and everything you want because it is yours. So this right exists without a counter obligation in the books of the other party. So you must have studied the definition of financial asset, where it is a right to receive cash or any other financial asset from a counterparty. That means in the case of financial asset, you need to have a counter obligation existing in the first place. Whereas in the case of any other asset, there is no need to have a counter obligation. Also, there may be certain assets which are not financial assets. In spite of that, counter obligations exist. Like for example, advance given to supplier for raw materials. Is it a financial asset for you? No, you have a right to receive material. You don't have a right to receive cash. So therefore, it is not a financial asset. But is this asset a counter obligation for your supplier? Yes, it is. So therefore, generally it is financial assets, but you may have certain non-financial assets where counter obligations exist. But counter obligations do not exist. In spite of that, right exists. Right over PPE, right over technical know-how, right over technical know-how. You have rights that exist for this, and therefore you can do the way you want without the counter obligation, and therefore these items also become your assets. So having a right does not mean somebody should have an obligation. No, may be there, may not be there, doesn't really matter. Have you understood the definition of the element asset? Yes. Have you guys understood the definition of asset now? Yes. Yes or no? Okay. Acha. Now, suppose you own land. Suppose you own a parcel of land. You have the right to develop, right to sell, right to keep it idle, right to lease, right to give for joint development agreement, etc., etc. Okay. You can do anything and everything with it. Okay. Now, each of these are separate rights. Each of these are separate rights. And each of these rights have a separate cash inflow. The nature of cash inflow is different in each of these rights. In the case of right to develop, you will develop the land, you will construct something on that, and then you will sell it. So therefore, your revenue or your economic benefit will come from sale of units. Right to sell the land, it will come from selling the land without developing it. Right to keep it idle, then your economic benefit is in the form of increase in the price of the land. That is capital appreciation, which is investment property under Ind AS 40. Right to lease, you can give it on lease and you can collect lease rentals. Right to give for joint development arrangement, you give it for joint development, he will sell something and give you, you will get some amount from sale of land as a lump sum, and you will also get part constructed units for yourself. So therefore, in each of these cases, the right is a different right. Yes, the inflow is different from each other. So now you tell me, will you recognize each of these rights separately in the balance sheet? Or will you recognize all these rights together under the heading of land? What do you think? What do you think? Each of these rights are different. Yes, development is different, sale is different, capital appreciation is different, leasing is different, giving for joint development agreement is different. Is the cash flow nature different in each of these 5-6 cases? Yes, it is. So in your balance sheet, when you have land with you, have you ever thought of it? ये land के इतने अलग-अलग uses है. You have so many different uses of this land. So do I recognize right to develop separately? Do I recognize right to sell separately? Right for capital appreciation separately? Right to lease separately? Right to give up for joint development arrangement separately? Do I recognize it like that? Or do I simply show it as land? The answer is, I will simply show it as land, because all these rights are ultimately linked to the fact that the entity is owning the land. The entity is owning the land. So therefore, when I show land in the balance sheet, it's not just the physical parcel of land which you can go and see there. Rather, that land is a bundle of all these rights put together. That land is a bundle of all these rights put together, along with what? Along with your control over that land. Along with your control over that land. You would probably have constructed compound walls. You would have security to look after that land. All these are exhibiting your control over that land. In the sub-registrar office, the land is in the company's name. This shows proof of ownership. So therefore, all these things, all these rights are nothing but offsprings of the asset land. And therefore, we show it as one asset under property, plant and equipment as land. But it is a bundle of all these rights put together. Ultimately, it is a bundle of all these rights put together. Okay, you will have to think it off like this, so then it starts to get more interesting. Okay, so now that concludes our discussion, I guess, on assets. Yes, and okay, sometimes there may be an existence uncertainty. Your vehicle got damaged in an accident. You have raised a claim with the insurance company. You do not know what will happen to that. So there is an existence certainty that policy is there, but what is the economic benefit that will flow? That will be the receivable amount you have to recognize. That I do not know. So that is an existence uncertainty. That is an existence uncertainty. And existence uncertainty can be mitigated only when additional information comes to you that mitigates the uncertainty relating to existence. That mitigates the uncertainty relating to existence. Okay, so ye ho gaya mera asset. We then move on to the next part, that is a liability. We then move on to the next part, that is a liability. See, ideally, it's very helpful if you read all the Ind AS first and then come to conceptual framework. Although practically the flow is first you build the framework, then you build the Ind AS. But today I'm sure you are able to appreciate the framework better because all of you know the Ind AS. So you are now able to appreciate the framework in a better way. Okay. So even when you are studying, don't jump to the framework initially. First, you finish all the Ind AS, study of the Ind AS, and then when you come to the framework, then your framework will probably get over in half an hour. Your framework will get over in half an hour because all these things you studied in Ind AS. Abhi, those are applications. Applications are more interesting. Ye to theory hai. This is, you know, the application. When you come to the theory, it will be Godspeed. Okay, so therefore, do the conceptual framework after finishing your Ind AS. Okay, next one. When you talk about liability, what is a liability? It is a present obligation. It is a present obligation to transfer economic resources. To transfer economic resources. To transfer economic resources as a result of past events. As a result of past events. Because of some event that happened in the past, you have an obligation. You have an obligation to transfer the resources. The important part that we have here is it necessary to know the identity of the counterparty? Is it necessary to know the identity of the counterparty? Matlab, present obligation to transfer economic resources as a result of past event. That means you have a sword on your head. You have an obligation which is hanging on you. The question is, do you need to know who is holding that hanging sword, or it is sufficient if the hanging sword is that there is nobody holding it? What do you think? Is it necessary to know the identity of the counterparty? If no, give me an example of a liability where the counterparty's identity is not known. Understood my question? The more you participate, the more it gets interesting. Okay. My question, should I know who is the owner of a liability as a reporting entity, or is it sufficient if I know that there is a liability? It's not concerned with whom I have to pay it to. If the answer is no, then give me an example of that liability. Give me an example of that liability. Okay. If the answer is yes, contingent liabilities. No, it is not necessary. Sarika Sharma is saying warranties, for example. Sumit Jain is saying contingent liability. Right now, I have not come to contingent liabilities, Sumit, but I'll be covering that immediately after liabilities. Okay. Any other answers? Okay. So Sarika Sharma has said warranty. Yes. Now see, the issue with warranty is you must have done Ind AS 115 or you would be doing it. Okay. So normally along with sale, when you build in a warranty, see what used to happen in AS9 was, in AS9, that is revenue recognition, you would recognize the sale and you would recognize a warranty liability or a warranty provision, jisko hum bolte hain. Okay, warranty on warranty provision. However, under Ind AS 115, what you are going to do is sale plus warranty. Along with that, when you do it, you will split the consideration into two parts. And as and when the performance obligation is fulfilled, you will recognize the revenue. So in AS9, it was kind of recognizing the entire revenue early. Whereas Ind AS 115 says that you delay the recognition of revenue. On sale, you recognize when the control over the asset is transferred. The warranty you recognize over the period of time when you have when you are guaranteeing the warranty arrangement. Okay, so now there won't be a provision for warranty under Ind AS 115 in this case, because the warranty provision itself is eliminated because my revenue recognition is delayed under Ind AS 115 because of the 5-step model. Okay, all right. Now the question is warranty provision. So under AS9, she was right. Identity is not known. Okay, all right. Great, Manoj Bhai. He has said you have to know because we cannot pay to any ghost or somebody. Okay, great. I'll give you one example. You will all understand it immediately. Most of them are saying not needed, not needed. Okay, all right. But look at this now. You have studied property, plant and equipment. Apply what you have studied. In property, plant and equipment, there was something known as decommissioning liability. There was something known as decommissioning liability or site restoration cost. Provision for site restoration cost. What we used to do, today I construct an oil rig. I have an obligation to rectify or make good the ocean bed after 40 years. Do I know whom I will contact after 40 years? I do not know. But do I have an obligation hanging on my head? Yes. What is that obligation? After 40 years, you have to rectify the seabed that you have drilled to collect the oil from. So do you have the obligation today? Yes. The moment you drill it, the obligation is yours. So therefore, there is no returning back. Provision means what? Uncertain, a liability with uncertain timing or amount. I do not know the amount. I know the timing after 40 years. Do I know to whom I have to pay? I do not know. So I make a provision. Provision bhi to kya? It is a form of a liability. Liability is certain. You know the amount, you know the timing, you know the person. Provision also is a liability in layman's terms. Only thing is I do not know when I have to pay or I do not know the timing of the outflow. So therefore, this is a liability where I do not know the identity. So knowing the identity of the counterparty is not required. Knowing the identity of the counterparty is not required. वो कोई भी हो सकता है. What is important is he could be anybody, XYZ. I am not worried about. What I should ensure is if there is a liability, I have to recognize it. Liability means what? There should be an obligation. There should be an obligation. So then it becomes a liability. Is it necessary to know the right? Answer is no. Site restoration cost and decommissioning liability kidhar hai? This is Ind AS 16. Read with Ind AS 37. All these standards you would have done. All these standards you would have done. This is just a recap of what we have been doing. Okay. Change in economic resources and claims. We talk about income. What is income? Income is nothing but increase in assets. Okay. It is nothing but increase in assets or a decrease in liability. Okay. So because of income, either your assets increase or liabilities decrease. That results ultimately in increase in equity. Okay, so your equity increases other than those relating to contribution from holders of equity claims. So your income is increase in asset or decrease in liability, which ultimately increases my equity. So if I put up my balance sheet, assets, liabilities, what it is saying, either my assets increases or my liability decreases as a result of which my equity stands to increase, and this increase is due to reasons other than contribution. Matlab, my shareholder should not have invested additionally. If they have invested, I will reduce that and then check whether there is an income, and then check whether there is an income. A very beautiful definition. It does not talk jargon. It talks plain logic. Okay. Increase in assets, decrease in liabilities, which ultimately goes into increasing my equity, other than those relating to contributions from holders of equity claims. Okay. So this expense is exactly opposite of this. Decrease in assets, increase in liabilities. Ultimately, what happens? My equity reduces. So it results in a decrease in equity, other than those that relate to distribution to holders of equity claims. Other than those that relate to distribution to holders of equity claims. Okay. That means other than dividend distributions, if there is a decrease in your equity, it means it is an expense. And other changes means what? Other changes means contributions from holders of equity, distributions to them, exchanges of assets or liabilities that do not result in increase or decreases in equity. So we have covered the definition of all these items, and we have also discussed about assets, liabilities. We have discussed transfer of an economic resource, present obligation. All these items are discussed. Just one thing which is there is, when I talked about asset, I told that there are three legs. One is it is a resource. Second is potential to produce economic benefits, right? Potential to produce economic benefits, and control. Okay. So what is control is what a small part that we have to discuss. We have discussed control at length when we did Ind AS 103, read with 110. So what do you mean by control? Control means present ability to direct the use of the economic resource. So you have the ability to say how that resource will be used. You have, suppose, machinery. You can say sell it off. You can say use it for production. You can say do it scrap. You can say keep it idle. All these things you are deciding. So you can be said that you control the economic resource if you direct how to use it, and direction is not enough. You obtain the economic benefits that may flow from it. It is not, Sarika, what is concluded? It's not necessary to know the identity of the opposite party. That's what I had told. Okay. It's not necessary. What is important is there should be a liability. That is sufficient. Once there is a liability, it kind of takes care of the fact that you have to recognize it. Because provision for decommissioning, I do not know from whom I'm going to get the decommissioning done. But is it a liability today? Yes, it is. It is a liability. And therefore, you will recognize it. So counterparty's identity is not necessary. Okay. Counterparty's identity is not necessary. All your provisions aise to hote, they are more like that only. Okay. Next one is, an entity controls an economic resource if it has the present ability to direct the use and obtains the economic benefits that may flow from it. So from that resource, any economic benefit that will come, it will flow to the entity that controls it. So when I say that obtain economic benefits, it means what? Sorry. It means obtain economic benefit and prevent others from enjoying that benefit. Prevent others from enjoying that benefit. Okay. This is the meaning of control. This is the meaning of control. Acha. Sir, what do you mean by prevent others from enjoying that benefit? Okay. All right. Now, let us take an example. Again, favorite, we will take Reliance Industries Limited has a chartered plane. This chartered plane is situated in it has an aircraft. Chartered plane means somebody owns it. It owns an aircraft. Okay, it owns an aeroplane. This aircraft is situated at the hangar of Mumbai Airport. Whenever Mukesh Ambani has to travel by the aircraft, he will first come to Mumbai Airport. And then he will board the aircraft. Mumbai Airport mein, we have each one of you who also have the right to enter Mumbai Airport to board your scheduled flights. So, Reliance Industries has a right, Mukesh Ambani representing Reliance Industries has a right to enter Mumbai Airport to go to his aircraft. Now, that right which he has does not mean Mumbai Airport is Reliance Industries asset. It does not mean that. Why? Because Mukesh Ambani, whatever he may be, however big he may be, can he prevent you from entering Mumbai Airport? No, he cannot. Mumbai Airport is a public asset. And therefore, the benefits of the public asset are enjoyed by the public. It may be a privileged individual like Mukesh Ambani. It may be normal people like us. But each of us enjoys this asset. It is not our asset because though we enjoy, we cannot prevent others from enjoying that benefit. Roads, for example, you have developed a residential complex and in front of your complex, a beautiful highway is passing through. Because of that highway, you are getting benefits in the sense the cost of your flats goes high. Can you say that the road is my asset? No, it's not. You are getting the benefit, yes. But can you prevent others from enjoying the benefit? Suppose on the same highway adjacent to that, 2 kilometers away, somebody else comes up with a township. Can you say no vehicle should pass in front of their township? Can you say that? No, you cannot. You cannot prevent that other township to enjoy the economic benefit. And therefore, that road strip does not become your asset. That road does not become your asset. When you talk about asset, there must be control. And the control means you must get economic benefits. And the other important part of that is you must prevent others from enjoying that benefit legally. Okay, legally. PPE is yours. You will prevent others from enjoying the benefit of that PPE. If you're unable to prevent that, then it is a general asset. And everybody gets economic benefit. So it is not in your control. It will not be your asset. Okay. All right. So that completes my discussion on incomes, expenses, assets, and liabilities. In all cases, it includes prevent others from getting economic benefits. Yes, when we talk about control, it always means I get the economic benefits and I prevent others from enjoying that benefit. You have a house, it is in your control. Why did you say it is in your control? Because you can decide who enters that house. You can decide. You can prevent a stranger from entering that house. So therefore, we can say that you have control over that asset. Is it okay? So that concludes our discussion on the elements. Yes. Definition of liability we have done. Present obligation, executory contracts, all these you can go through. It's not Very difficult. Okay. Equity, you know, it is the residual claim. From assets, you deduct the liabilities, that becomes your equity. Definition of incomes and expenses we have discussed. Okay. Now the question is, when do you recognize your elements? When do you recognize your elements? So in all your standards, that's right, Manoj bhai, that's right. Okay. It is a public property, so no one can restrain to enjoy the benefit. That is why your public properties, though you are getting the benefit, it is a resource for you. You are getting the benefit. In spite of that, you cannot say that it is your asset. Indigo lands its aircraft at Mumbai airport, from where passengers board. So it is a resource. The airport is a resource. It is getting benefits. Passengers board from Mumbai airport. Can Indigo say Mumbai airport is my asset? No, it cannot, because it cannot stop Vistara from landing. It cannot stop SpiceJet from landing. It cannot stop Emirates from landing. So it is a general asset. It is a public asset, and therefore it is not within the control of Indigo. Okay. All right. The recognition process. What do you mean by recognition? Well, recognition is the process of capturing for inclusion in the balance sheet an item that meets the definition of one of the elements. Simple. Meets the definition of element, you recognize the asset. So all these things, you know it. Okay. Opening balance sheet, you start with opening balance sheet. You record items of profit and loss. You record changes in equity. So what does it give you? It gives you the closing balance sheet. Remember, an asset or liability can be recognized, or income, expense, equity, whatever it is. It can be recognized only if it meets the definition of elements. Only if it meets the definition of elements. And what are elements? Those 5 elements of the conceptual framework. Okay. If after recognizing any one of these elements, you do not meet the criteria, or you transfer, or you extinguish a liability, you repay a liability, you collect a receivable, then what you have to do? You will have to de-recognize it. You will have to de-recognize it. So typically, when you recognize income, income means what? Incomes are credited. So what are you going to debit? Debit will be either your assets go up in the form of cash and cash equivalents, or assets in the form of trade receivables go up. Or the third thing is your liability goes down. Your liability goes down. For example, you collected advance from a customer, and now you have supplied goods to him. So now what you will do? You will recognize the revenue, and you will eliminate that advance, because against that advance, you have already supplied the goods. So when you recognize income, the credit will be to income, debit will be to asset, or to the liability, or to the liability. Expense is opposite. Expense is opposite. At the same time, when you recognize revenue, you will also recognize an expense at the same time. When you make a sale of goods, you will recognize the cash received as income. So the entry will be cash account debit to sales. Cash account debit to sales. Okay. But when you sell the inventory, that is your cost, right? So you will then pass the entry cost of sales account debit to inventory. Cost of sales account debit to inventory. That is exactly what is written here. Okay. So you will recognize it. Okay. So we call this as matching of cost with income, but it is not an objective of the financial, of the framework. Matching of cost is not an objective of the conceptual framework. It is not. Conceptual framework only tells, do not allow recognition in the balance sheet of items that do not meet the definition of asset, liability or equity. उसके बाद आप matching cost करो या फिर matching मत करो, that is not concerned with the framework. The framework says we are not concerned with that. We are saying recognize asset, liability, equity, income, expense when the respective criterion which are laid down in the framework are met. Okay. All right. Fine. So all this we have done. Relevance, existence, uncertainty, I have discussed. Low probability, I have already discussed with you. When there is a low probability, you have to assess whether recognizing an asset is giving faithful representation, relevant information, or whether it will be misleading if you recognize the asset. For example, you have an asset, the probability of realizing that is very low, like an insurance. It depends on certain future conditions. So then what are you going to do? Will you recognize the asset? No, I will show it as a disclosure. That's it. Same goes for a liability also. Same goes for a contingent liability. What is a contingent liability? A liability whose outcome depends on certain events not in control of the entity. Not in control of the entity. Or it could also mean a liability whose amount to be paid is not known, or it is very low, or the probability of paying is very low. So that becomes a contingent liability. So then you will have to decide whether recognition of such items with low probability, will it affect my faithful representation or not? If not, then the typical location for such information is in the notes. You disclose it in the notes and we are done with that. We are done with that. Okay. So remember, faithful representation and relevance. In every place in this chapter, they have hammered the words faithful representation, relevance. Aaj ke baad, when you look at your financial statements, ask yourself these two questions. Is this information relevant? Is it faithfully presented? If not, then at that point of time, you will recognize, you will see that you will tell not to recognize. Okay. All right. What about credit sale on approval basis? See, under Ind AS 115, there is a detailed guidance about sale on approval basis. Okay. So you will have to follow the guidelines based on that particular Ind AS. Okay. The framework only tells you that recognize asset, liability, income, expense, equity if they meet the definition. Ind AS 115 tells estimate the probability of returns and then recognize the revenue. Okay, so that is how you will do the accounting, how you will do the recognition. Okay, so that kind of takes care of this element also. Derecognition, when the asset is realized or the liability is extinguished. Remember, recognition criteria could be assets, liability, income, expense, or equity. All these things put together. Why? Because when you recognize asset, corresponding income is recognized. When you recognize liability, corresponding expense is recognized. When you get the investment from equity holders, it is equity which is recognized. When you distribute, it is equity which is credited, okay, which is debited. But in the case of derecognition, it is only assets, liabilities, and equity. Sir, what do you mean by derecognition? Removing something which exists. Now, incomes and expenses, they do not have any closing balance. They do not have any closing balance. And when they don't have any closing balance, what are you going to derecognize? So therefore, you can derecognize items which exist, which in our case are assets, liabilities, and equity, which in our case are assets, liabilities, and equity. Okay, so that takes care of that unit. Okay, we are still, oh, it's 10 o'clock. Okay, we will do these units. It's not much now. Okay, we should be able to complete it in another half an hour or 40 minutes, not more than that. Okay, all right. Where did it go? Measurement. Now the question is, we discussed what to recognize, that is the elements of financial statements. We discussed when to recognize, the timing. We discussed the characteristics. We discussed the enhancing features. And now we come at what amount should I recognize? At what amount? This is where you have always been using the terms Ind AS follows a fair value approach. When the first time you came to final, अरे अब Ind AS बनाना है, fair value approach है everywhere. This concept, the measurement concept, touches on what are the bases that we have, how do I have to recognize, and what do each of these measurement bases represent. So there are two measurement bases. One is historical cost and the other is current value. Historical cost is the cost model. Current value has again three categories: fair value, value in use for assets, fulfillment value for liabilities, and current cost. Okay. What do you mean by historical cost and current value? Historical cost means what? Derived from the price that existed on the date of transaction. Current value, you will use the information at each balance sheet date. Current value could be any of the three options. Historical cost is only one option. Okay. So therefore, current value could be any of the three. So at each measurement date, you will use the current value, which could be fair value, value in use, or current cost. Okay. Changes in values are not reflected in historical cost. When you acquire property, plant, and equipment under the cost model, do you think any movement in the value of PPE will affect your asset cost? Answer is no, it won't, except for changes relating to impairment or liability becoming onerous. When your asset is impaired, you have to recognize that even under historical cost model. When liability becomes onerous, that means the benefit that you are going, that means the what you can say, the cost of fulfilling the liability increases. Okay, that means the liability has become onerous. So therefore, you will recognize onerous liabilities and impairment only these two things. Rest all you will not reflect it. And current value, you will reflect the changes since the previous measurement date. That means at each balance sheet date, you will do a fair valuation or a revaluation, whatever it is. Okay. So you will reflect the changes since the previous measurement date in estimates of cash flows and other factors reflected in those current values. So that is what is your measurement distinction: historical cost and current value. Okay. When you talk about historical cost, ye to fatafat hoga. What is your component? The first is the cost of the asset, which is consideration plus the transaction cost. In the case of liability, what it is? Liability is at amortized cost. Consideration received minus the transaction cost. Okay. The changes that arise in an asset is on account of depreciation or amortization, which is consumption of part or all of the economic resource and constitutes the asset. When you recognize depreciation, it means you are writing off that asset over a period of time. So that is what is the change that you are having. The liabilities, you don't have such kind of a concept. Okay. Then when you get the payments from your assets, in respect of your assets, then what are you going to do? You will take it to extinguish that asset. And when you repay your liabilities, you will extinguish it. Repay the liabilities or deliver the goods. Okay. Making payments or by delivery of goods, you will extinguish. This is all under historical cost. Or impairment will be recognized. Or onerous liability will be recognized. When the liability that you have, the value of that has gone up. So that means the liability has become onerous. And subsequently, any interest on to reflect any financing component also you can recognize. Okay, so this is your brief picture on historical cost. Quite simple actually. Okay, quite simple. It's what you have already been doing. When we talk about current value, this is also quite simple. You talk about exit price and entry value. Okay, so ye raha exit, ये रहा entry. Exit price means price to sell an asset or transfer a liability. Price to sell an asset or transfer a liability. Entry value means price to purchase an asset or a liability. Price to purchase an asset or a liability. Okay, so now generally, if transactions happen normally, then exit value and entry value are the same. Generally, if transactions happen on fair terms, then entry value and exit value are the same. Very simple. No, suppose I have this bottle of water. I sell it to you for 20. We are unrelated parties. Okay. So now for you, the entry price is 20. For me, the exit price is 20. Okay, so that is what is the meaning of exit price and entry price. Mostly it is the same, but in some cases the exit price is different, which is fair value or value in use. Okay, fair value or value in use. These are the concepts of fair exit value. Okay, these are the concepts of exit value. This is from the perspective of the market participant. What fair value is from the perspective of market participant, exactly what is defined in Ind AS 113. Exactly what is defined in Ind AS 113. Whereas value in use or fulfillment value of liability, this is entity specific. This is entity specific. It always talks about what are the cash flows the entity will generate, what is the disposal value of this particular asset. All these things make it entity specific. Make it entity specific. Okay. Value in use. Value in use. Okay. Value in use is nothing but present value of the cash flows. Present value of the cash flows that an entity expects to derive from the use of an asset as well as the ultimate disposal. Whose perspective? Well, market participants' perspective for fair value, whereas for value in use, it is from the entity specific perspective. How is it determined fair value? Well, you can directly observe active markets or by using measurement techniques. We have done this in 113. Cannot be observed directly and are determined using cash flow based measurement techniques. Okay. Transaction costs are not considered in the case of fair value, neither on initial recognition nor on disposal of asset. Whereas in the case of transaction cost under fair value, under value in use, initial recognition you don't consider, but when you calculate the expected net proceeds, that time you will deduct the transaction cost. All this is what you have done in Ind AS 36. Okay, I'm not taking anything new. Okay, all right. Entry cost, entry value versus current cost. Entry value, that is current cost. What do you mean by current cost? Replacement cost, which is what you have studied in Ind AS 2 on inventories. I have this pencil with me. What is the price I will have to pay to get the same pencil today? That becomes my current cost. That becomes my current cost. So therefore, it is also an entry value. It is also an entry value. And hence, if you compare it with historical cost is the value on the date of acquisition, whereas current cost is the value at each measurement date. Components, you have asset, that is consideration plus transaction cost. For liability, it is consideration minus transaction cost. Okay. Whereas in the case of current cost, it is the consideration that would be paid. How much will I pay to get liabilities, or how much will I receive if I sell my asset? That would be paid. So this becomes my differentiating factor. This becomes my differentiating factor. Okay. Next, you can in fact understand these things better because it is something which you have already done. Okay, we are talking about assets. Carrying amount, primary value, transaction cost. Under historical cost model, whatever is unconsumed, uncollected, recoverable, that will come, and transaction cost is added to that. Current cost, to the extent unconsumed or uncollected and receivable, this you will recognize. Next, fair value, price received to sell the asset without deducting transaction cost. Without deducting transaction cost. Okay, and present value of future cash flows from the use of the asset and from ultimate disposal after deducting present value of transaction cost on disposal. Okay, in the statement of P&L, guys, this you can all just go through. Okay, it's something which you are already aware of. Okay, something which you have already aware of. So my advice is, these things, if I start read it, it will just become reading. My advice is, when you refer measurement base, please go Ind AS 109 financial instruments, Ind AS 3840. Okay, Ind AS 163840. The measurement criteria, recognition criteria, everything is given in these standards. Everything is given in these standards. So just brush up that information, and then when you look at the measurement chapter, you should be able to understand. Otherwise, right now it is only going through as a reading, which is something that I do not want to do. Okay, because I would rather prefer to have some discussion on what you have not understood. Okay, so just go through these items. If there is anything, you can always reach out to me. Okay, you can always reach out to me. So assets, liabilities, balance sheet, all these things you will have to do. Sir, which measurement base should I follow? Should I follow historical cost, fair value, value in use, current cost? What should I follow? Well, you will obviously have to consider relevance, faithful presentation, consistency, certainty, asset or liability, contribution to future cash flows, which is absolutely what we have been doing right from the morning. Look at the relevance, look at the faithful representation. You cannot record a derivative using amortized cost model. Sir, why? Arey Baba, derivative ka value, the value of a derivative changes with the change in value of the underlying asset. So therefore, for something whose value keeps on changing, how can you follow amortized cost? That does not become faithful representation. That does not become faithful representation. You will have to recognize, you will have to follow the fair value model for derivatives. However, suppose you are having an investment in a fixed deposit, which you have held solely for the purpose of collection of principal and interest. That is SFPPI model, solely for the purpose of principal and interest. Now here, do you think you will calculate the fixed fair value of the fixed deposit? Nahi hoga. You are holding it solely for collecting cash flows in the form of interest and principal, and therefore that will be measured using which cost? Using amortized cost. You cannot follow the fair value to your fixed deposit, because the purpose is only for collecting principal and interest. Okay, so this is what you will have to look into. It is again looking at relevance and faithful representation. From that prism, from that glasses, this makes infinite sense. Okay, so any information, whenever you are presented with an option, you have to ask yourself whether this presentation gives relevance, whether it enhances my faithful representation. If yes, go ahead. If not, if it makes it misleading, you can always skip presenting in that particular fashion. Okay, so this one example, just go through. It is a simple example of a factoring arrangement. The factoring arrangement does not mean I have to de-recognize my receivables, because it appears that the credit risk remains with the party. The credit risk remains with the party. Okay. So this one you can all go through. I have discussed this question with you. Okay, Ind AS 38 and the framework, whether there is any conflict. Directors are particular about usefulness. They have opined that although Ind AS implement a fair value model, they fail in reflecting the usefulness as they do not reflect the financial value of the entity. Ind AS financials never give the value. They represent the data. The value is derived by analysts based on that data. Okay, so therefore, they do not reflect the financial value of the entity. And discuss the view as regards use of fair value. Well, the fair value cannot be used in each and every transaction. It will be used for some assets, some liabilities. Yes, it is again a mixed approach. It is again a mixed approach. Okay, so discuss the views as regards the use of fair value in Ind AS and the fact that Ind AS do not reflect the financial value of an entity. They do not. It is not a special purpose financial report. It is a general purpose financial report, and therefore you will recognize it as it is. They are not meant to give the value. वो purpose ही नहीं है sir हमारा. Giving the value of the entity is not our purpose in the first place, and therefore it is not going to be affected. Okay, so you will have to tell in that particular manner. You'll have to give the answer. Okay. All right. Everywhere you see comparability, enhancement, etc. Okay. Measurement of equity, more than one measurement base can be used. More than one measurement base can be used. So if you have an interest bearing financial asset, you can use FVT OCI, where the interest goes to P&L and the changes in fair value goes to other comprehensive income. So you can go through these things. It's not difficult because you have done. Everywhere you see comparability, understandability, verifiability, all these things you have already done. Okay. So when transactions, the next thing is fair value, where transactions could be on market terms or could not be on market terms. So when they are on market terms, then normally the cost is similar to the fair value. Cost is similar to the fair value if it is on market terms. Okay. Therefore, whether historical cost or current value is used, the same basis is also normally appropriate at initial recognition. Exchange of asset or liability, then initial measure determines whether any income arises from the transaction. Okay, so you calculate the fair value and do it. Okay, not on market terms. You got land in the form of a government grant. That is not on market terms. That is not on market terms. You give a loan to subsidiary at a concessional rate of interest. That is not on market terms. Liability may be imposed by penalty. Liability may be imposed by legislation or regulation. That is not a market term. Okay. So now in this case, what are you going to do? Measure the asset or liability at deemed cost. Measure the asset or liability at deemed cost. You got land. If you don't show that land in your books, how are your books giving a faithful representation? They aren't. So you will have to show the land at a particular value, Okay. In some such cases, a current value is used as a deemed cost. A current value is used as a deemed cost on initial recognition. That deemed cost is then used for subsequent measurement at historical cost. So when you receive land from government by way of a grant, you will recognize that land based on the market value, based on the fair value to say. Okay. If you give loan to a subsidiary at concessional rate of interest, you do a fair valuation of the loan. Whatever is the fair value, recognize the liability. The difference between loan given and fair value is probably going to be the equity infusion in the subsidiary. So you will recognize it as an equity. You give loan on concessional rate to your employees. Then what are you going to do? Recognize interest on the normal interest rate, and whatever benefit you are giving in the form of reduced interest rate, that will be expended in your P&L as employee benefit cost. That will be expended as employee benefit cost. Okay. So can you follow more than one measurement basis? Yes. Yes, you can. Okay. So that takes care of chapter 7. It's a simple one. Last 2 chapters are there before we complete. Presentation and disclosure. Chota sa hai. Presentation classification is the sorting of assets liabilities on the basis of shared characteristics. So in your balance sheet and P&L, we will start to aggregate. We will start to aggregate depending on similar items of shared characteristics. Okay. Classification is applied to the unit of account selected for an asset or liability. Okay. Offsetting is usually not permitted. It is generally not permitted. You cannot offset asset and liability against one another unless it is permitted to be settled on a net basis. Like for example, financial asset minus provision for expected credit loss, PPE less provision for depreciation. These are all asset backed provisions and their offsetting is permitted. But in general, dissimilar items cannot be offset. You will be showing it separately. Classification of equity, classify them separately if they have different characteristics. Okay. Income and expenses, components have different characteristics, are identified separately. Oh, it's all common sense. Okay. Profit or loss and other comprehensive income, all these things you can check. Aggregation also you can check. Illustration 4, please do it once you have studied Ind AS 105. Okay. Once you have done 105, please go through illustration 4. Okay. All right. Capital maintenance and concepts of capital and capital maintenance, your last discussion on this topic. I have hurried up in the last 3-4 chapters because that is something which you guys are already aware of. The core part I have already discussed with you, where you have a lot of theory questions that can come up. I have told you what standards you need to refer and then you need to revisit the conceptual framework. So my advice, as I told you before also, first you finish all Ind ASs. Once you finish all Ind ASs, you are thorough with recognition, derecognition, measurement, disclosures, everything you know. And those concepts which you recollect, then you come and read conceptual framework. You should be in a position to understand this chapter easily. You should be in a position to understand these concepts easily. Is it okay? Yes. Any doubts so far, guys? Any doubts? Any anything you would like to add up to this? Yes. Anything you would like to add up? Just the last topic for today and then we are done. Okay. The last topic for today and then we are done. Anything? Anything you would like to add? Okay. Concept of capital. Well, I have 2 concepts. Okay. One is financial capital and the other is physical capital. One is financial and the other is physical. Okay. All right. Next one. When you talk about financial capital, at nominal value, at purchasing power. These are the 2 things. This is based on your operating capacity. Okay. So that is going to be our last point. What do you mean by capital maintenance and the concept of profit? Well, the financial capital model tells us that if your opening capital is given to you and your closing capital is given to you and opening is greater than closing, then we say that we have made a profit. Then we say that we have made a profit, which is obviously correct. Okay, but here it is a little bit different. Okay, so I will look at my opening capital. I will look at closing capital after deducting drawings. Okay, after deducting drawings. Don't go into the concept of SOPL and all those things. This is a standalone concept. Just understand. Opening capital, closing capital after deducting the drawings kitna hai. That if it is higher, it represents your profit. That represents your profit. This is under the nominal value. So now let us come to an example. You will understand better. Okay. A trader commenced business on 1st Jan 20X1 with 12,000 represented by 6,000 units of a certain product at rupees 2 per unit. Okay. During the year, he sold these units at 3 rupees per unit and had withdrawn 6,000. So opening capital was how much? 12,000. Closing capital. Well, he made 18,000 rupees by selling it minus drawings. Minus drawings. He withdrew 6,000. So 18 minus 6, your closing is 12. So therefore, the profit that you have generated under the financial capital concept is 0. Under the financial capital concept, nominal value is 0. You can see opening equity 12,000, closing equity also is 12,000. That is 18 minus 6 represented by cash. So the retained profit is 0 and you can again start off the new year with 6,000 units. Okay. So therefore this is your financial capital concept. The next one is you are given the price indices. Okay, that is now we are moving to purchasing power. Purchasing power. Okay, now opening equity, you have 12,000 represented by 6,000 units at 2 rupees per unit. So opening, what am I having? Equity 12,000, stock 12,000, which is 6,000 into 2, which is 6,000 into 2. Next, opening equity at closing price. Okay, now see, closing price. Now please pay attention. Cash. You sold these. You got 18,000 and then you withdrew 6,000. So therefore your equity is 12,000. Okay. This is what is the picture now. But at the same time, I am given the option or the information relating to indices. So opening index was 100. Closing index was 120. Now your opening selling price was 2. So if I cross multiply 2 into 120 divided by 100, closing price would be 2.4. Opening, I had 6,000 units. So 2 into 6,000 is 12,000 rupees. If I have to purchase 6,000, I should have had 14,400 rupees with me closing. However, what is the closing that I have? I have only 12,000. So therefore, will you be able to buy 6,000 units? Answer is no, you will not be able to buy 6,000 rupees units. You will be able to buy below 6,000. Why? Because you have drawn that 6,000. So therefore your cash invested in the business is 12,000. But because of the overall increase in purchasing power, your units, which were 2 rupees at the opening, became 2.4 at the end. And therefore, you will actually need 14,400. And how much you are having? You are having 12,000. So therefore, 2,400 becomes your loss. 2,400 becomes your loss. Okay. Opening equity 12,000. Opening equity at closing price is 14,400. Closing equity is 12,000. So retained profit is negative 2,400. Because he has withdrawn 6,000, he has only 12,000 in the with himself, and in 12,000 he will not be able to buy 2,000. He will not be able to buy 6,000 units, and therefore we say that under the financial capital purchasing power concept, the entity has made a loss of 2,400 rupees. Okay. And finally, physical capital maintenance. This is also simple, but there is a small rectification in this problem, which I feel. Okay. So let us just see this. Suppose the price of the product at the end of the year is 2.5 per unit. Okay. Now see. Opening balance sheet. Opening balance sheet. Stock 12,000. Equity capital 12,000. How do I get this stock? 6,000 into 2. Closing balance sheet. This is your actual position. Okay. Cash. I sold for 18,000, kept 6,000 with me. My cash is 12,000 and equity capital is 12,000. 18,000 minus 6,000. Okay. So this is your position. In effect, 12,000 divided by 2.5, which is my closing price. Price at the end of the year is 2.5. So when I do 12,000 by 2.5, my capacity, physical capacity is 4,800 units. My physical capacity is 4,800 units. Opening capacity was how much? 6,000 units. So therefore, is there a profit or a loss? There is a loss. Why is there a loss, sir? This loss is because, why do you call it a loss? Because my capacity has gone down. Earlier, for the same business size, I could trade in 6,000 units. Now in the same business size, I can trade only in 4,800 units, and therefore there is a loss. So what is the amount of the loss? What is the amount of the loss? Well, it can be worked out something like this. Okay. Closing capital required for 6,000 units is equal to 6,000 into 2.5. So that is 15,000 rupees. Okay. That is 15,000 rupees less opening capital. Opening capital rupees 12,000. Sorry, not opening, less actual closing capital, which is this figure. Okay, which is this figure, 12,000. You should have had a capital balance of 15,000. You are having a capital of 12,000. So this becomes your loss. This is my answer, which I think is correct. But what the institute has done is, what is done in the solution is, closing capital required. It has done this, which is 6,000 into 2.5. That is 15,000 minus drawings of 6,000. I don't know why this particular thing is done. Okay, he has taken closing capital to be not required. Actual closing capital they have taken as 9,000. Closing capital required is 15,000, same as above. So what they have said that 6,000 is your loss. This is what is the answer that is given in the institute. They have taken closing capital to be, you need 6,000 units. So 6,000 into 2.5, 15,000. But you have also drawn 6,000. So probably they must be thinking that 15 minus 6, 9,000. To maintain parity, they have taken that 9,000 will be your closing capital, and closing capital required will be 15,000, which is exactly this figure. Okay, it is exactly this figure. And then they have said your loss is 6,000. But actually speaking, when you are arriving at closing capital on actual basis, you have already deducted the drawings of 6,000. So I don't see the reason why again you need to deduct the drawings of 6,000 here. But nevertheless, they have deducted it. So we respect that and we close the topic with that. Okay. I would suggest you follow the answer given by the institute, but there is a conflict because CA intermediate, if you open the study material, CA intermediate, last question on framework is exactly the same. And there they have done the method that I just now explained. Whereas CA final, old framework, last question, plus new framework, last question, they have done above treatment. So there is some kind of inconsistency. We should be expecting a corrigendum in this regard. Okay, we should be expecting a corrigendum in this regard. Until then, please follow what the module has done. Okay, because I do not want you to go with the treatment that pata nahi sir ne kya sikhaya. Okay, we hope for a corrigendum. Okay, let us see. So that is the meaning of financial and physical capital maintenance. Financial capital means what? Your money power at the beginning, at the end, if it remains the same, you have not made a profit. If your closing capital money power is high compared to opening, you have made a profit. Whereas physical concept, your operating capacity or productive capacity at the end, if it is lower than the opening, it is a loss. If it is higher, it is a profit. Okay. So with that, we have concluded your chapter on conceptual framework. I have hurried certain units relating to measurement basis and as well as relating to your what you can say, certain concepts which I felt you would be able to understand better if you just have a revision of the concepts related to financial assets, liabilities, and the standards which you have studied. I understand that you are coming from a background which last 2 months you have been focusing on other topics. So if you have at all kept pace with your FR portions, I think you should be more or less comfortable with the financial concepts that we have discussed today. Okay, so that concludes us. Any questions that we have? Anybody still left with me? Any questions that we have? Manoj, thank you. Sumit Jain is done. Kanikas is done. Any questions? Any comments? I have been a little fast, I know that, but if you have not understood, I'm always reachable. Okay, I'm always reachable. All right. Okay, so that is better. If you revise in days, it's better because then this chapter will hardly take a time span of half an hour. You give it half an hour, this chapter gets over. Okay, but was it helpful? Could you go away with some learnings? No doubts. Priya Garg, thank you. Priya Garg. Anybody else? Namita, Tota, Sarika, Kanika, Sumit, Manoj has said Sairam, Naveen, Srinidhi. Anybody else? Geeta Patel. No doubts. It is an easy chapter. It is an important one because amendment hai, so you can expect your questions to come from the amendment. Yes, but it is easy at the same time. Okay, so no doubts. Then shall we conclude the session? Sir, whether the method which you explained for the last problem can also be presented, that's what. See, even we are in a dilemma regarding that. Okay, because intermediate, they have discussed the alternative that I told you. Same to same question. Okay, whereas final, this presentation is there. So right now I would suggest please follow what the institute has done to avoid inconsistencies. But yes, the correct one is what I discussed, the alternative method. You can just state that as a note. Okay, you can state that as a note, but I think you should be getting some clarification from the institute. Okay, we can hope for a clarification. So that should, ease out the things to a great extent. That should ease out the things to a great extent. We'll hope for a clarification. I'll write regarding that. Okay. All right. Thank you, everyone. Then see you. I don't know when is my next class. Is probably on 8th of March for Ind AS 102 November 22 attempt. Okay. So see you guys on March 8th. Until then, stay safe and study well. Okay. All the best to the May 22 guys. You have completed your syllabus today, and it has been a pleasure teaching you. Wish you all the very best in your examinations. Okay, wish you all the very best. Do well in your attempt, clear, qualify, and welcome. I extend a warm advanced welcome to your professional life. Okay, thank you everyone.